Well, good evening to everyone, and welcome to our second Mellow Monday of the season. And it's going to be a long season, as you can see from COVID. I don't think it's going to go away, and I can't see us doing a huge physical event while it's up and running. So this is where we're going to be for the next year, and we got some fantastic entertainment lined up for you. How many of you, it seems, or so many of you, buy your tickets last minute? Literally on Friday, we were in a position where we thought we might be slightly below the numbers of the first one in September. Now we've gone way over, double the number of ticket buyers have happened literally over the weekend and today. So it's great. We're 42% ahead of where we were in September. And that's nice to know. If we were a name company growing by 42% in 3 weeks, we'd be called Nova Shit. But anyway, sorry, Nova Sit. I have to be careful there. Anyway, the good news as well tonight, apart from the fact that we've got Ed and Oliver about to come on for the Stockopedia investment team, we've also got Ed appearing with us at the grand finale, so lots to see of Ed tonight, which is lovely. But one thing I would just like to mention to you, because I know about 147, we think, of you are actually here for the very first time. So on that basis, you need to know we don't have any official breaks. We're going to be 3.5 hours of non-stop entertainment. So if you want to go and grab a cuppa, you're going to have to pick your own opportune moment to do it. And we also have a Q&A facility, which you'll see on your screen at the bottom. That's the Q&A facility we use for asking questions during the evening. So when you put your question up, we will see it, the presenters will see it, and we will pick them off. They will hopefully replay the question so that you know as an audience what it was, and they'll answer it too. The other thing you need to know, I'm in, as is Ed, I think, and Oliver too, we're in our mellow blue colour. It's not just mellow blue. This weekend, I'm happy to say it's Everton blue, which is my team. Top of the Premiership. It's not all the time we're going to be at the top of the Premiership. I'd like them to be, but probably won't be. But I'm going to wear my blue because we are. So well done to Everton, keeping up there. And on investor information, we have 5 companies that we're going to be discussing in the bash at the end, so don't miss that. I think you've probably all seen the program. It's been up on the website for the last week. So over to you guys now. It's the Stockopedia team. You're going to tell us how you've had this amazing performance. We'd expect nothing less, as you've got all the data. You should be right up there, but tell us how you did it.
Okay, thanks, Dave. In true Stredder style, I think we've got very, very short amount of time. Oh no, that's not right. Hang on. Can you see my screen? Not sure. I'm trying to share my screen, and you can.
Yeah, I can see it.
Okay, great. The Zoom is a little bit confusing, so it seems to have disappeared. But if you can see my slides, that's great. So we basically, about a month ago, I wrote a blog talking all about the investment club that we started with staff, and it got a really wonderful response. And Dave asked me to come and talk about it on Mello. So thanks very much, Dave. He's given us, of course, 20 minutes to run through all of this. So we're going to have to rattle through. But basically, we started. I've been thinking for some time. There's a lot of experts at Stockopedia HQ, including Oliver, who's on here. I will introduce him shortly. But actually, a lot of staff are specialists in what they do, from designers to front-end engineers to marketers and things like that. And while they're always interested in investing, many are younger and often, are slightly anxious about putting their sort of savings into the stock market because, as we all know, it's very volatile. And I always encourage everyone. So you've got to get skin in the game, start an ISA, start spread betting, whatever it may be, but get started. And it's harder, it's hard to get started. So I tried to think about a way to overcome this. And I thought back to a time when my father helped set up, my father and I and a brother set up an investment club for my family. And that was a wonderful way for my siblings and cousins to all get stuck in together. And back then, of course, we would meet in the pub every time, once a month. But the sort of frictions of the real world sort of stopped us from, getting together too often eventually over time. So it did sort of disintegrate. But it was a wonderful way of really getting started in investing for many people. And we actually took the shell of that old family investment club and turned it into the staff investment club. And everybody sort of, a bit anxiously sort of got sort of harangued into this. And we got started. And really, we've seen some really great results. And one of the things that I really wanted in the goals of this was to actually get all staff thinking like investors. So encouraging everyone to sort of contribute and to pitch stocks and to use the site like our own subscribers do. And that's really been one of the great benefits. And also to let novices experience the full stock market journey alongside more seasoned investors. Obviously, the other great benefit was lots of us were investing on our own PAs, but it actually has provided a forum for us to all share research and tap into sort of the broader team scuttlebutt. And of course, we hoped we would profit greatly from this. Now, okay, 1 year is not a decade, but we've done okay so far, so that's been good. Now, I know, having spoken to lots of people, because lots of people have opened up about their investment clubs to me. Starting an investment club is a really fantastic thing to do, but it's also quite rare these days. I would encourage everybody, if you do invest with friends or family, to start a club, because it's easier than you think. Yes, there are a few things you have to straighten out at the beginning. Who's the chairman? Who's the treasurer? We have a portfolio manager in Ollie. We also have a secretary. You have to figure out and get a bank account and a brokerage. We use Interactive Investors. We found very good for investment clubs. And you also need to set down and lay down your constitution and investment process. I'm not going to go into all of that today because we're not got much time. But essentially, the way it works is you track it, a bit like a sort of a unit trust. The portfolio is split into units. And a lot of clubs will use something like iClub or iValuation, I think is one that some people use to track the unit valuation. We've actually done it in a spreadsheet because Ollie, who's here, is the spreadsheet master. And every month we actually have a set date. Everybody buys in, normally by direct debit, and they'll buy units at a given price. And obviously the price reflects the underlying value at that time. But we only allow people to sort of buy and sell at very fixed intervals to make it easier on the accounting. We meet, well, actually before COVID hit, we were meeting once a month. And Ollie will talk about how that impacted the investment process. But essentially, the way it works is we have a meeting, we've got a fixed schedule, and we'll review previous minutes. We'll give a portfolio review. Ollie normally gives a market review. We do between 1 and 3 stock pitches, which is all different people. We might do a knowledge share or educational section, and then we'll have proposals. Proposals might be a change in our investment process or something like that. And obviously after that, we'll vote on the outcome of the proposals and the pitches. And that's really it. It's quite straightforward, and it normally takes about an hour to 90 minutes, depending on what happens. Now I'm going to hand over to Ollie, who's going to talk about the investment process. Go for it.
Thanks, Ed. So,
Ollie, by the way, Ollie Cooper is a CFA, a very, very smart man. And he does an awful lot of work behind the scenes for Stockopedia subscribers, if you are a subscriber, and especially on the portfolios. And he's working heavily on fund and trust, including that into the site and so forth. So here's Ollie, and welcome.
Yeah, thank you very much. So as I previously mentioned, we wanted to start our club with an investment process that we could all agree on. And of course, this will continue to evolve over time, but with new ideas and new proposals. But this is what we've currently settled on. So in terms of buy rules, the main things we're looking for are a minimum of stock rank above 75. Obviously, there is a Stockopedia investment club, so this might be expected. But ultimately, the rule here is to ensure we're investing in companies with good fundamentals and good momentum and exposure to the factors that have been rewarded over time. We're just trying to put the odds in our favour. We've got a market cap greater than 20 million. This is a basic filter for liquidity. We go in more depth when the stock is actually pitched. Now, we did have price greater than the 200-day moving average. Now, this was initially added to encourage picking shares on the uptrend. However, we've recently had it, we voted to have this dropped. This was during the COVID crisis. We wanted to take advantage of some depressed prices, which were by definition below their 200-day moving average. And finally, for a stock to be selected, it has to be voted by more than 50% of the club. And we'll talk about the voting system a bit later. In terms of sales, we have two forms. One is stop-loss rules. These are semi-automatic, so they're rules-based alerts, but they're not automatically set with our broker. From these, we've got a price-based stop-loss. This is based on the purchase price of the stock, and that varies from 12% to 30%, depending on the volatility or the risk rating of the stock. We have a fundamental stop-loss if the if the stock rank falls below 50. That's to prevent us from or alert us to deteriorating fundamentals in the security. The other way we could sell is via a proposal to sell. A member can propose as any company that we own to be sold, which is then subsequently voted on. This will generally be based where the company's seen a change in fortune, or that could be a drift in the stock ranks, red flags in the numbers, or a qualitative change that could severely impact the business. Again, similar to buy, we need a majority to hold. Finally, we also have a 1-year review for all the positions that we hold. So we talked about the voting system. It's worth mentioning how this has improved over time. So we used to, in our group meetings, do hands up type of voting. We quickly found that there's quite a few issues with this. One was that the best presenter could sway the vote very easily. The other point was there was quite a lot of social proof happening, people following the crowd, especially some of our newer investors who would just look around at others and then use that to make the decision. And also for some people, this might be the first time they've looked at a stock. So it wasn't perhaps enough time for people to really challenge the analysis or draw their own conclusion. So we changed this to a Google Form survey. Now this is sent out individually after each meeting, and then each member has got time to consider their choices and vote independently. The other element we've done is try to alleviate a bias towards buy transactions. And by doing this, we've added an additional question, which is how many positions should we buy? This adds a qualifier for it, and we use the mean to determine the value, because it's very easy to say buy, but it's by adding this, it makes it more considered choice. So how does this work in practice? Well, this is a real life example from our club, and where we had 2 stocks pitched, Fair Expo and Way Education. For each, there was the usual should we buy X, but we also had how many should we buy? And you can see here that by taking that how many should we buy, the weighted score was 1.08, which meant we had license to buy 1 new position. As Way Education was more supported than Fair Expo, that was then the decision to buy Way. I'll just hand over now to Ed, who's going to talk about the pitches themselves.
Yeah, so the pitching process. Oh, and just to be clear on that last slide, if Fair Expo had also weighted heavily towards the buy, but not as much as Way Education, we still have only bought 1. Obviously, Ollie made that clear. So pitching a stock, one of the things that's quite intimidating when you're researching a stock, and you end up with people pitching in all kinds of formats. And so what we started to do is try to sort of make this easier for people who don't normally pitch stocks, because there's a lot of anxiety if you've never done it before. What do I do? What do I cover? So actually, over time, we created our own template. So in every single meeting, normally 2 or 3 companies are pitched, and we've got a little bit of a rota. Normally people put their hands up, but if we've tried to have Ollie's actually got a spreadsheet which spits out a random person who's got to pitch at the next meeting. So that means that the shy ones have to come and do it as well. Each pitch generally is done in 10 or 15 minutes, but the research on it can take up to a day. A standardized template is used, and I'll go through that in a minute. And normally ideas are sourced from wherever. We're trying to actually get a little bit more systematic on this, but at the moment ideas either come from more social sources, whether it's Stockopedia discussion boards, Twitter, Research Tree, or places like that. But also from stock ranks and screens that we've set up. So we've actually got a few specific investment club screens that people can go to as idea sources. Obviously, the ideas have to qualify for the rules that Ollie set out earlier, stock rank 75, market cap above 20 million. Q&A is encouraged, but generally only 1 of the shares is bought. So last week we actually bought, or a couple of weeks ago, we actually bought 2. And the pitch template, I've got more in the appendix. And I'm happy to send these slides out afterwards if David will distribute them. essentially the template is quite straightforward. I'll rattle through it. We start with a profile, and in each of these 9 headings, there are a range of different questions to be answered, and they sort of guide people through some of the things to think about. And you know, we're trying to sort of always align our picks with kind of strong, we call factor exposure. So good quality, good momentum, reasonable valuation. And so the pitch is redesigned to kind of bring out the story of the stock and across all the bases. I hope we haven't missed anything. But essentially the profile, obviously all the basics, the ticker, the exchange, liquidity, its general profile. We tend to also ask, what's the opportunity type? So we like to classify shares, and you know, in my experience, there's certain sort of key ways people can make money in the stock market. Whether you kind of got a growth share, growth at a reasonable price, or a turnaround, or contrarian pick, different styles and flavors of shares that. And we've got a little categorization we like to sort of ask everyone to sort of, you know, have a look at and classify the pick. We've actually, as you'll see, most of our picks are of a certain ilk, but we'll go into that later. Business and model, obviously, what it's about. You know, what's the history, and also what's the business model? How does it make money? A lot of times people don't actually say how a business makes money. It's very different if you have a subscription business to, you know, another sort of deal making business, but that's an important point. The market and competition, we found that some of the best ways of finding out information about market is in admissions documents. You go and hunt down the admissions documents, you know, of a company or its competitors. Often there's some really, really good information and intel in there. Obviously try and map out the competition itself, and also try and look at the competitive advantage of a company, if there is one, and whether it's durable. So we have a few different factors we like to look at to see if it's got a moat, whether it's got a network effect or a brand or whatever it may be. And I think it's always good to have those on your list when you're doing a bit of research. Looking at financials, obviously we're quite more biased towards growth shares. And so we look at growth and profitability, balance sheet strength, look at the debt. And we always like to look at the ownership structure of the company as well, and whether good funds that we like and know are buying into the shares, and whether there's evidence that the you know, management are backing it, whether they have ownership or they're buying in the market. Valuation, obviously relative valuation important, but not essential. We're tending to buy premium shares. And I'm trying to encourage everyone to at least find some intrinsic valuation indicators, for example, from Research Tree, which I do think is a great resource, and Rob Mundy's done a great job there, because you can find DCF valuations by analysts in the city. You might have always a bit too overconfident, but you know, it's always another factor. Macro trends, secular trends, and any upcoming catalysts. One of the things we found is that we've been using quite a lot of alternative data sources on some of these picks. For example, from web traffic data has always been quite predictive, we found. Also mapping out risks, near-term hurdles, and obviously a sweep through latest RNSs and recent trading and sentiment. So broker coverage. And also what I like to say, I like to ask everyone to look at the private investor sentiment on discussion boards, and always to answer the question, what would the person selling be thinking, and why are they selling to us if we are buying? So that's a pretty brief scan of the pitch template. But actually, when we've published some of these pitches, it's been quite interesting, because often people are more interested in the template for the pitch than they actually are in the pitch itself. So that's been quite useful. And I think we're going to publish a bit more on that. We do have all the research, these pitches on the site. We've been going through a backlog of our current holdings. So some of these, yes, they have been from a few months ago or even 6 months ago, but actually we're starting to publish pieces right after our meetings. So actually our latest meeting, we bought Novacyte, and we actually bought Loop Up. The Loop Up, I think, write-up is coming this week. So we're trying to get them out within a couple of weeks of our actual meeting. So it's all there on the site. Now I'm going to pass back to Ollie, who's going to talk a little bit about the performance of the portfolio.
Yeah, so this chart shows the return of the club since inception, which was the 6th of February, versus the all share and the AIM all share. It's a time weighted return, so it ignores the inflows and subscriptions to the fund. As you can see, we're pretty happy with how it's performed. We're up 44% since inception versus 20% for the FTSE all share and about 1.5% for the AIMS all share. This chart also shows the journey. Okay, Ed, if you go back one.
Oh, sorry.
So it shows the journey. You can see that stop loss is triggered in March, which helped to reduce our downside. And we missed some of the initial rebound, but we quickly benefited from the stock selection, which has been very strong. So you can see how it performed against the benchmark, but what about other funds? Well, this shows the IA sector, the IA all companies sector, and it shows the 6-month period from the March end to September end. Each grey line is a potential fund that you could have invested in this period, and they're ranked from worst on the left with performance of minus 0.9%, and on the right is the best with 49.5%. The orange bar is the median, which is 15.4%. And if you think the returns are quite high here, it's worth remembering that March ends, so it's close to the bottom of the COVID crisis. How's the fund returned? Well, we're the blue line at the top there. We're very pleased to say that we would have ranked at the top of the IA all companies sector with a performance of 66.7%. Now, of course, this doesn't mean that it will continue forever. And of course, some funds may have a different risk profile to ours and different exposures. But it's nice to see that the fund is up there with the big boy institutions.
Yeah, we have definitely invested more in speculative securities. So I think we're very aware that we may have significant drawdowns along the way. But generally with the I'm probably the oldest in the investment club, and I'm 45. So actually most people have got fairly high risk tolerance. Ollie, do you want to go and talk a little bit about the current portfolio?
Yeah, so this just shows the current portfolio and the gains in it. The major driver for our performance has been best of the best, which was pitched by our very own Jack Brumbury. But however, we've also had other good performance over the period. Gamed, Sylvania Platinum, Codemasters Group, and Hotstock Noversight has also contributed quite quickly. Ed, was there something you want to say on the names?
No, it's just more interesting thematically, and I think that'll be backed up by the next slide. Yes, we have. I think one of the things is we're tending to get into some of these names a bit later than many of the subscribers on the site. But we are, and many of them have had a fairly good run before we've even started buying them. And I think that we're trying to buy strength. Relative strength is very predictive in the market, but also we've been very thematic. And I remember we're pitching 2 or 3 stocks each meeting. So it's not, there are a lot which the club are saying no to, and it's very democratic, the voting process. But actually the themes that we've seen have been very much along the lines of biotech and med research. We've got software and IT. These are very COVID beneficiary kind of sectors, as well as, let's say, IG hasn't contributed yet, but that's all about retail trading. And we've also got some precious metals, Shanta Gold, Sylvania Platinum, etc. So it's been actually quite, which is on perhaps on the theme of, significant monetary and fiscal stimulus. So some of these, been a very thematic portfolio year to date. And that's kind of backed up in this more sector chart, Ollie.
Yeah, so you can see for our sector allocations, we've got biases to certain sectors, healthcare, tech, mining. However, one thing it is worth noting, although we've got these sector-based differences, at the higher level, the disparity is a lot smaller. So we're overweight defensive 4% in aggregate, cyclical 7%, and just underweight sensitives the rest. We've got strong biases to high flyers and super stocks, currently at 75-25.
Yeah, and this is my last slide, David, is, anybody does know these bubble charts I like to get out every now and then, but on the vertical axis here, you've got momentum. So high momentum is up the top, and on the horizontal axis is quality. So good quality, profitable shares. These are very high quality, high momentum shares, and each bubble represents one of the portfolio, and they're all in that category. So, this is something we're obviously very, very heavily weighted towards. I would say more speculative, small cap, high flyers. I'm actually starting to encourage the investment club to start looking for turnaround shares, of which there are a lot of very interesting opportunities in the market. And I'd like to see us diversify actually the sort of composure of the portfolio over the next year. The great thing about an investment club is you have more cash to play with every single month. So you can keep finding and buying new opportunities or topping up the positions you most like. That's it, David. I don't know if we've got time for Q&A, but.
Absolutely brilliant. No, we haven't, but there are quite a few questions there. So if you can copy them over at your end, and we'll copy them, and we'll put them on the website, all your answers.
Okay.
And hopefully you can get them on the Stockopedia sites as well, so that people understand all these various.
Great. No worries.
Various
Yeah, we will follow this up. Ollie and I were just saying, actually, there's lots of good material here, and we'll try and turn it into some articles.
Brilliant material. And we want to hear from everybody who's in an investment club. So we want to try and really get the game rolling on having a league of some kind and introducing a few more clubs as we go along.
Absolutely. I know David's in a club. I know that others are. And please do ping on the site, add comments to any blogs and let us know if you're in a club. I don't know if Charles Ford's out there, but he was one of the inspirations for us. He came into the office and gave a presentation. Anyway, thanks a lot, David.
Yeah,
and I know you've got a tight schedule.
See you later. Yeah, thank you very much.
Bye-bye.
There's 300 of you on this webinar now, so I'm sure there's a few clubs out there. Anyway, over to Cliff now. Are you with us there, Cliff?
Yeah, hi, I'm here. Yeah.
Excellent. Cliff's from ShareSoc. He's a fellow director, and he's going to tell us about the latest campaigns that ShareSoc are involved in. Over to you, Cliff.
Hi. Am I sharing my screen, David?
You are. It's coming through good.
ShareSoc does two things. It supports individual investors and provides reports, tools, networking opportunities, forums, education opportunities, and more. But ShareSoc also campaigns to improve the rights of individual shareholders. If you look at the slide, you'll see a group of people standing on top of the UK flag, on top of the world, with our shields of cash and our investments. At least the flags are meant to be showing share certificates, and we're all marching together because we are a movement trying to make things better. That's why I'm a director of ShareSoc. It's to make the world a better place for individual investors. Thank you, David, for that introduction. I've been investing actually since 1984. I stacked the Jaguar flotation, made a few hundred quid. And times have moved on, but the world is not perfect for the individual investor, and I think we need to campaign to make it better. I want to tell you tonight about three particular campaigns. First, capital gains tax. We've just made a submission to the Office of Tax Simplification. If you were like me, then you've got loads of capital gains, and what's the point of having loads of money tied up in AstraZeneca, where if I sold it, I'd have to pay 20% tax on the gains? Surely it's much better for me to reinvest my capital into half a dozen potentially fast growth but high risk companies in biotechnology, pharmaceuticals, or some other high tech area. That's the logic behind our proposal to the government about capital gains tax. The government should be looking to provide a stimulus for reinvestment in the economy in these awful COVID times, hence our CGT response. We have also responded to a consultation on stamp duty. We think it's unfair that individuals have to pay 0.5% stamp duty on purchase of UK shares. You don't have to pay stamp duty on AIM shares, and you don't have to pay stamp duty on overseas shares, like Apple. But and in practice, most of the high frequency traders, hedge funds and the like, don't pay stamp duty. If you buy your shares via contracts for difference or through options, then you don't have to pay stamp duty. It's a nonsense. It's not a level playing field. Why shouldn't we simply set the stamp duty at the rate of 0.05% for all, rather than 0.5% for the small proportion of investors who actually pay it? Our main and most important campaign is on shareholder rights, or nominee accounts in particular. We think there needs to be the name on the register, on the shareholder register, so that individual investors get as of right information about corporate actions, AGMs, and they have full voting rights. Following years of lobbying by ShareSoc and UTSA, we have finally persuaded the government to instruct the Law Commission to look at these issues, and the Law Commission are about to report on their review of intermediated securities. This is also tied up with the dematerialization of paper share certificates. We are really hopeful that the report will be positive. They are due to publish their report in November, and we need to watch this carefully. It may well be that following publication, we will ourselves have a large campaign to make sure there is no backsliding. Many companies and organizations prefer the status quo of disempowering individual investors. We are severely concerned of the motives of certain platforms, funds, companies and other institutions, and we are wary they may lobby to preserve the status quo. But don't worry, folks, we're looking after your interests. And these three are not the only campaigns that ShareSoc is doing. You can see a full list on the ShareSoc website. We do, however, need your support to make change happen. Please join ShareSoc if you're not already a member. It's only 45 quid, and it's only 30 quid if you're a season ticket holder for MelloMondays. And lastly, can I give a plug for the ShareSoc masterclasses, and in particular for the remuneration masterclass tomorrow at 5 p.m. with me, Judith McKenzie, the leading fund manager of Downing, and the chief executive of Allenby Capital, Nick Naylor. The seminar's free. It's a taster for our other masterclasses, which you will have to pay for. And the link is here on the screen. It's going to be great, so please sign up. Thank you. Back to you, David.
Brilliant, Cliff. Well done. You got that through in super fast time. Excellent. I think everybody will certainly put their hand up for lower stamp duty and CGT. That's for sure. That's a vote winner. For those of you who are annual pass holders, and probably about half of you on this webinar have actually bought an annual pass, there are lots and lots of benefits of having one outside of just coming to the MelloMonday. And the masterclasses are half price, the ShareSoc masterclasses, so it's worth having an annual pass if you have one. Great. Anyway, thank you, Cliff. And now we have our first company presentation. It's over to Peter Harrison, who's there waiting in the wings. I'm sure you've done a few presentations today, Peter. And well done on the results that were released this morning. Peter's from Bioventix, and for many of you will know Bioventix from many years gone by. They've been a great company we've had at Mello for a number of years. In fact, anyone who came to Mello in Derby in 2014 and bought shares after Peter's presentation then would have 6.5 times their money in their account now if they sold them today. So well done, Peter. Before you even start, you've made a few people some nice money. But they're not stopping. They're still doing new things. And here's Peter to tell us all about it. Thank you, Peter.
Greetings from Farnham, everybody, in my office at home. I'm going to attempt to share my screen with you. Let's see what happens when I do this. Has that shared okay?
Yeah.
So if I go into presentation mode, is that even better?
Oh yeah, we can see that.
Okay, well, very good. I'm assuming everybody can hear me okay. It's not quite the same as attending in person, but let's proceed anyway. So what I'll do is I'll go through the presentation and results that were released today on the markets, and I'll talk through a bit of background for the business for people that aren't familiar, and I'll focus on some of the financial performance and also some of the implications of the pandemic on our little business in Farnham. So I'll talk to you about antibodies and blood testing, which is our core business, how our business works and the dynamics of it, and how we achieve a remarkable revenue continuity. Some highlights of our results released today, what we have in the pipeline for the future, and a bit about our facilities in Farnham, and just some brief comments on our shareholders, directors, and then some conclusions for you. So our business is all about blood testing. So the vast majority of our antibodies go into automated blood testing machines, and these machines exist at hospitals around the world. Blood samples get taken. They are trafficked into these automated blood testing machines that robotically analyze hundreds of thousands of blood samples for various things to diagnose heart disease, thyroid function, fertility, infectious disease, cancer, etc. And these machines are placed in hospitals around the world by big multinationals such as Roche and Siemens and Abbott Laboratories, Beckman Coulter, etc. Many of the tests, well, all the tests have reagent packs, and that's the picture in the bottom right-hand corner. And many of the tests use antibodies as part of the reagent pack and being a crucial part of the functioning of the test. And the green Y-shaped thing is a schematic of an antibody, and the job of an antibody is to bind to antigens or targets or so-called antigens. And what happens when these antibodies are used in blood testing formats is that the antibody in the reagent pack starts off life being naked, so it's waiting to find two molecules. When the robot in the machine mixes some reagent pack, which contains the antibody, with the blood, which will contain the hormone or whatever that is being tested for, a binding event takes place, and the machine quantifies that, and that's how blood tests form. And that's how results are generated by these blood testing machines. So what we do in our little lab in Farnham is that we create new antibodies and we mass produce them using fermentation technology to make 10 or 20 grams of purified antibody per year that we send to the manufacturers at Roche and Siemens and Abbott in their places of manufacture for incorporation into their reagent packs. And those sales account for around 30% of our annual revenues of 10 million. So we get about £3 million or so of revenue from selling physical antibody to these companies for incorporation into their reagent packs. In addition to that, part of the pricing mechanism is that when companies use our antibodies in final product tests and they sell those to people around the world at their customers in hospitals, we derive a small modest royalty from that downstream commercial transaction, and it's that generates 60 to 70% of our annual revenues, and it's the key to the remarkable profitability of our business. So it's a great pricing mechanism if you can achieve it, and you can achieve it if you can make great antibodies that make great blood tests. So that's the core of the business. And in the pink dialogue box, I'm trying to make some comment about the pandemic and its impact on us. And the pandemic's had an effect on everybody on the planet. We are no different. And the pandemic has affected blood testing pathways in two ways. The first of which is that hospitals around the world have reallocated their resources to deal with coronavirus patients. Certainly during the course of April, May, June in Western Europe, hospitals were really not doing an awful lot of routine work, and if they're not doing routine work, then routine blood samples aren't being taken for routine analysis. And I think the other aspect of the pandemic is that it's had an impact on patient behaviour. So even where diagnostic pathways have existed at hospitals, people with fertility problems or thyroid problems or sometimes even heart disease problems have not presented to doctors and hospitals to be diagnosed with their disease, and that has had an impact on routine blood testing. So we are pandemic influenced from that perspective. So the way our business works is that we'll have an idea to make some antibodies, and that's the yellow cloud at top left. And some of these ideas come from our own thinking, and some of them can be customers' initiatives where customers supply us with an idea, reagents and know-how to create antibodies. We then go through our technology where we immunize sheep and we take out sheep white blood cells. We ferment sheep white blood cells to make the purified antibodies, and that all takes us about a year to achieve. Thereafter, what happens is that we send samples to our client customers, be they a contract R&D customer or just a customer for the fruits of our own research. At that point, on the second line, what the customer will then do is to synthesize prototype reagent packs in their labs, which then enable them to run some prototype blood tests on their blood testing equipment in their research labs, using frozen blood samples that they will have in their freezers. That will then enable them to tell whether a guest antibody from Bioventix potentially has an improved performance over an existing antibody. And the answer to that might be yes or no. If the answer is yes, and their commercial people think there's merit in taking things further forward, that a project is created, and that can result in 2 or 3 or 4 years of work within that blood testing company to develop all the data required from field trials and manufacturing validations to get that new prototype test turned into a sales a marketable product which they can sell to hospitals around the world. Just making the obvious point that blood testing is a highly regulated business, and the machines are regulated, and the reagent packs are regulated as well. And that has an influence on our business insofar as it creates a natural lag of approximately 5 years between research that we might be doing in our lab in Farnham and tangible product sales and royalties in the future. So there's a natural lead time lag phase there. But the other impact on the business dynamics is that after one of our customers has been through this process of getting a blood test approved that uses one of our antibodies, then there's a natural barrier to that antibody being replaced by an alternative antibody, being it equal or even slightly better. The consequence is that our customer would be required to repeat a large amount of prototyping and field trials and regulatory submissions in order to switch from one antibody to another. And that naturally creates a barrier to entry. And that's at the heart of a number of our long-term recurring revenues. So that being said, we've made a number of antibodies, probably 20 or so over the last 15 or so years that are used globally at our customers, such as troponin for chest pain diagnostics for heart attacks. We've got an antibody for thyroid function, the T3 antibody. We've got a number of antibodies used in fertility testing for testosterone, estradiol, and progesterone. We've had antibodies for heart failure diagnostics, which is subtly different to heart attacks, which is an acute condition, whereas heart failure being a chronic heart disease. Our biggest seller, as we'll find out later, is the vitamin D antibody for vitamin D deficiency testing. And we also make some antibodies for various drug and antibiotic testing. So that's where the antibodies get used. In terms of results, many of you will have seen the results published this morning, and my personal view is it's been quite a remarkable year with revenues of 10.3 million. Regular viewers will note that actually we did 5.3 in July to December 2019, so just 5 million in Jan to June 2020, and there is a bit of a clue as to a pandemic effect. We're fairly sure that happened in Q2 2020. So that being said, it was still nevertheless a remarkable year, and because we have a very modest operation in Farnham with just 12 full-time equivalents and a small board with low cost, and that results in what appears to be quite a remarkable level of profitability of 8.2 million before tax and 7.2 after tax. And so those are large numbers for a small business measured in people. And so consequently that generates a lot of cash, and we keep a certain amount of cash for our operational needs and for reasons of flexibility. The remainder of our cash generation is shared with our loyal shareholders, and so consequently we distribute a lot of cash in the form of dividends, and that's grown over the previous years. But as I repeat again in the pink box, there has been an impact of the pandemic. And as to when the pandemic will draw to a conclusion and how it will evolve over the next months and years, we have no great insight on that. I could speculate, but I don't think there's any great value. But what is true to say is that when things do return to normal and blood testing returns to normality, then our business will very quickly return to its normal trajectory. And we look forward to that with a due sense of optimism. Looking at the different antibodies that we sell, you can see pretty clearly that vitamin D, the vitamin D antibody for vitamin D deficiency testing dominates our revenues, with kind of 45% accounted for by that single antibody. Vitamin D sales have grown by 20 to 25% over the last few years. And that's beginning to plateau as we've kind of suspected for a while, but there's tangible evidence of that regardless of any pandemic effect. In actual fact, vitamin D is interesting because there's kind of two reflections on vitamin D and the pandemic. One is that there's a lot of interest in vitamin D because it appears that people who are deficient with vitamin D seem to fare much worse in hospitals with coronavirus, and so that I think has prompted people in that setting to test more people with presenting with coronavirus for their vitamin D levels as a means of better understanding the link between the two, and there is evidently a link. And the fact that there is a link, I think, is really interesting because for me it convinces me that vitamin D testing is here to stay, because it's clearly a fundamental part of human biology and an important part of the function of the immune system. Whilst that's very positive for vitamin D, we're also aware of the fact that a lot of the vitamin D tests are part of routine testing, and people on routine annual medical checks might not just be participating in those right now, and that could lead to a negative effect on vitamin D tests in a pandemic era, which we are going through right now. We've got another revenue stream, the one in red next to it, which has grown at sort of 10 to 15% over the last few years, but here we are with a -4% figure for the recent year, and that's largely due to Q2 2020 in my view. And that is again as a result of people with heart failure who are not attending clinics and not being tested for NT-proBNP. And I think it further manifest evidence of people's changed behaviour in their interaction with hospitals and clinics. And then to the right of that, we've got a set of 1, 2, 3, or 5 antibodies in blue, some drugs, T3, and then the steroid antibodies for fertility. I tend to group those together as our core historic business. Each one of those tends to be up and down from year to year, but as a group, they performed pretty well over the last few years and have continued to do so. Some will be more pandemic affected than others. My guess would be that the fertility ones, testosterone, progesterone, and estradiol, were more likely to be pandemic affected because people with fertility problems, I think, are even less likely to present at hospitals and doctors to present along the diagnostic pathway. Most interesting from a positive perspective is the way that the troponin revenues have grown. So this is an antibody that's used by Siemens and another company for heart attack testing. And this is a new test from Siemens that's rolling out to replace an old test that is not as sensitive and quick as the new test. And as Siemens roll out this new test globally, we're seeing quite a significant ramping up of sales. And over the last 2.5 years, we've seen 6 monthly sales figures grow in a very pleasing way, and it convinces us further that this is a further demonstration of Siemens and their activities in rolling out this new test. And this is just the start of a global rollout, and it's one directional, so that when hospitals change from an inferior test to a superior test, there's no turning back. So whilst there's a lot of effort required for hospitals to change a heart attack test, after they've done so and seen an improvement, there's no turning back. So that's something we're looking forward to for further growth in the future. Troponin will dominate our growth over the next 4 or 5 years. There's nothing else that we're doing in our lab that will have any impact in that time frame. So having said that, we are engaged in a number of other activities in our research pipeline. I will very briefly describe the ones in the top left, secretin urine and the company Cardinal. That project is all to do with diagnosing people with arrhythmia, so that's irregular heartbeats. The amyloid project is measuring fragments of amyloid beta in Alzheimer's patients. Both of those have progressed scientifically, but as yet don't really have what I would call a definitive proof of concept that convinces me that both those projects have a viable future. So whilst they're exciting and we're committed to them, in this situation where there's no proof of concept, a fair appraisal of probability of success, I think, remains low. We're involved in some THC testing, and that's something that will be interesting for the future. Pollution biomonitoring is on the next slide. So I think I might skip that straight away, as I think that's interesting. And I do want to allow plenty of time for questions later. So what we've done in the pollution exposure projects is to identify a component of pollution that we can measure and we can identify in people's urine. So it works like a drug test, but it's measuring pollution exposure over the last day or so. We've got a prototype lab test, which is the kit on the right. That's like a shoebox sized product with a plastic plate and some reagent bottles that we can send to someone in a lab anywhere in the world, and they will be able to perform a pollution exposure test on samples of urine. We want to promote this test for people globally who are interested in pollution exposure and the impact of pollution or airborne pollution on downstream healthcare events. So using the same antibody technology and antibody pairs, we've set up a lateral flow test or a point of care or field use kit. And this is the schematic on the right. And these are, if you were to dissect a pregnancy test, you would see just a collection of filter papers, and it would look very much like this. And it's a prototype test for our pollution exposure project, which has been shown to work quite neatly on samples that we prepared ourselves. And the next step for that will be to package this product in a plastic cassette and package it for use in health and safety monitoring, most likely with a phone app that will be capable of measuring the intensity of those grey-blue lines that you can see on slide 9. That's quite an exciting project for the future. It has a number of technical and marketing hurdles to come through before it generates any value, sort of 2025 to 2035, but it's something that is exciting. We've continued to spend some money on the upgrade of our lab facilities in Farnham, and you can see the before and after photo of £100,000 worth of investment in lab furniture and lab equipment, and that's something that we've continued the work over the last couple of years to take the lab to a point of complete upgrade, and that work is drawing to a close sort of around about the turn of the year or Q1 2021. We have issues with COVID-19 at work, and we have to make sure, like other companies, that we look after our workers and we have safe working practices, and the staff have been great in responding to that challenge. There's a snapshot of our investors. Some of the people in the audience have bravely invested, and there are others, some larger entities, and you recognise a number of household names from there who have become shareholders in Bioventix, and I think we're quite lucky to have got such a wide range of high quality investors, and that is as a function of the business, and it's a function of the efforts of our friends at ThinkCap to help promote that process. There's a rogues gallery of the directors with me top left. Ian's our chairman, has been around for a number of years. So has Nick, and we've got a new non-executive finance director, Bruce, who's joined recently and is helping us in our finance efforts. So to conclude on all of that, I think we've had an excellent year despite the coronavirus impact. It is affecting routine blood testing, but things will return to normal, as will our business at some stage in the future when the pandemic recedes, as it surely will. The troponin rollout is exciting, and that's something that will generate significant revenues in the future, as will some other projects in our research pipeline, and the pollution exposure one is something that I think is particularly exciting. And that's it for me, David, and I know you've been fielding questions because you said you would.
I have, and we got quite a few, Peter. The first one to come up, you mentioned in your results today the 6-monthly nature of our customer royalty reporting. To be clear, does it mean that your results for the 12 months to June 2020 encompass royalty payments for the 12 months to December 2019?
The way that the royalty revenues work with our customers, that they're reported 6 monthly, so and they're reported in February for the second half of the calendar year, and they're reported in August for the first 6 months of the calendar year. So, for example, in August, I would have had an email or a report from the finance department of a customer saying that they've sold $100,000 worth of kits based on an antibody, and therefore they owe us $2,000. And almost at the same time, we'll get a $2,000 transferred from Western Union, and that appears in our revenue. Well, it's converted to sterling at the time of arrival, and so $2,000 will be worth, £1,600, and there'll be an invoice that's backdated to 30th of June, because that's the period in which those royalty revenues have been earned. So monies arrive in August. They're exchanged immediately into sterling at the rate operating at that time, but they relate to January to June, and so we have a 30th of June invoice that's backdated and applies to that period.
Great. And someone here is asking, can Peter please tell us more about the project with Cardinor and pre-diagnostics in Norway, and mention what made him invest more last year in pre-diagnostics?
Okay, I'll start with Cardinor and scrutineurine. So this group in Oslo have been working on scrutineurine for around 5 to 10 years. Scrutineurine is not part of routine diagnostics. It's a research interest only. The people in Oslo believe that scrutineurine is important in the beating of the heart, and is reflective of the robustness of the heartbeat, and they think that it's involved in arrhythmia. Arrhythmia is something that is suffered by quite frequently by people with heart failure. So often the transition is heart attack leads to muscle loss, muscle wasting, weakened heart. Weakened heart means low pumping volume. Low pumping volume means shortness of breath, and which is heart failure. So a heart attack can lead to heart failure, and significant muscle damage in the heart can often lead to arrhythmia or an irregular heartbeat, and it affects the natural pacemaker in the atrium of the heart, and an irregular heartbeat can lead to sudden cardiac arrest. Sudden cardiac arrest when you're in your kitchen pretty much always leads to death. And this can be treated with implantable devices which monitor the heartbeat and also in parallel detect and then defibrillate and re-stimulate your heart. So they are lifesavers for certain people who have heart failure, but the clinicians don't really have a great idea of who needs them and who doesn't. They're very expensive to implant, and they're very expensive to manage and monitor. And for some patients, they're life-saving, and for some other patients, it's a waste of money and resource. And so clinicians and patients would better like to know whether they are genuine candidates who would benefit, or whether it should be avoided. And clearly, the accountants will have their own view on that. So the hypothesis is that testing for scrutineurine will better able the clinicians to make a decision with the patient to implant these devices or not. And if that can be done more intelligently, then it's better for patients, better for doctors, and better for healthcare providers. And it might even be better for suppliers of these devices, such as Medtronic and Boston Scientific, who have an interest in the better and more intelligent application of these life-saving devices. So it's all really interesting. The only caution I add is that there is as yet no real definitive proof with patient samples that that hypothesis is correct. So we're still waiting for a real proof of principle with scrutineurine. And actually it's quite similar with amyloid beta and pre-diagnostics and Alzheimer's research and diagnostics. So we have a number of antibodies and assays which detect fragments of amyloid beta which might be released by the brain or from the brain, appear in blood, and may or may not be a telltale sign of Alzheimer's disease or embryonic Alzheimer's disease, which would be very important for pharmaceutical companies to identify who's in the early embryonic stages of Alzheimer's disease. So we've made some amazing antibodies and some prototype assays for amyloid beta with pre-diagnostics, but once again, whilst it's exciting, there isn't really as yet any proof of concept that that the hypothesis of amyloid fragment diagnostics has future merit and that these people have a route forward. So whilst that's the case, I rank it as exciting science that we should be involved with, but realistically a modest probability of success based on the fact that we don't have proof of concept yet.
Okay, a couple of quick ones then. The pollution tests sound interesting and very topical, but what pollutants exactly? And will they be seen just by industry or for home use maybe?
Well, that's a good question. Thank you for whoever asked that. We've identified a component of pollution that is ubiquitous from all forms of combustion, be it coal, natural gas, log burning stoves, oil, diesel, petrol, rubbish tips. All forms of pollution, all forms of combustion give off this entity that's in particulate matter, and everybody on the call is breathing it in all the time, indoors and outdoors. We've identified a component of it, and we've obviously we've made antibodies, and we've used our assay technology to construct these two tests, a lab test and dipstick or lateral flow test, that detects this component of pollution in urine, and it using similar principles to drug tests which detect metabolites of drugs in the urine, but the only difference is measuring a component of pollution. The levels are about 100-fold lower than, say, the levels of THC marijuana that you might find in someone's urine. But nevertheless, we've used our technology to successfully detect levels in low levels of pollution in people in Farnham, and lower levels of people in the north of Norway, where we've harvested some samples and got some lower levels. And obviously, if you get smokers, then the levels are much higher because they auto pollute themselves through smoking. So that's exciting, and I think that it's got a clear route forward. Initially, I think it will be in a health and safety testing environment where workers are tested for things already, pollution elements, and it would allow health and safety people to adopt an on-site use rather than having to send samples off to health and safety labs, such as the one that we have in Buxton in Derbyshire.
Great. Well, one last one, and I must say there are about 15 questions here, so we can't get them all in.
Got to carefully pick one then, David.
Well, I'll even create my own so I don't embarrass anyone else. But can we say that we will answer as many as possible and put them on our website maybe in a couple of days' time for those who missed out on the answers? And the other thing that we could do, of course, is to have a sort of a Q&A that we print and allow everyone to see.
Yeah, you could always field the surplus questions that we haven't answered, David. Put it on an email, and I'll send it back to you, and then you can post that in whatever way suits you.
Great. So one last question, it's from me. You're always, in my view, very relaxed. The company is doing brilliantly. I've known you for 10 years and more now. What keeps you awake at night? Anything you're worried about?
My sleeping patterns, I don't think, are affected by Bioventix. Some people think that if you have a series of dry nights, like I'm on this, this is a plug for Brewdog AF, which is low alcohol. Some people think that helps you sleep. I'm not utterly convinced by that. Sometimes I sleep well, sometimes I don't. But certainly the work doesn't keep me awake. I sometimes wake up feeling quite excited by some of the projects that we have at work, and when I talk about secretion in the urine and amyloid and pollution and other things that we've got, we're very lucky to be involved with such exciting research projects. It excites me and other members of the team. So it doesn't keep me awake at night, but it is very exciting, and that's why I keep doing what I do. And I think we've got many more years of of interesting science and developments ahead of us. Not all of them will work, but hopefully some will, and will create a bit of additional interest and additional value for loyal shareholders.
Excellent. Well, I know so many long-term holders, as you do too. So we're all happy to stay with you, and well done today and every other day, and to the staff, of course. We haven't got that many staff, so you're doing a great job on such a low number.
Thank you very much indeed, and thank you so much for inviting me to join. Much appreciated.
Thank you.
All right, bye everybody.
Great. Bye. All right, well, our next session, we're over to Mark. He's going to give us the first of his investing rules series. It's going to be quite a long series because Mark's got quite a few rules he wants to get through over the coming months. And over to you, Mark. Tell us all about it.
Great. Thanks, David. Hello, everybody. Let me just try and share my screen. Hopefully this will work, and you should be able to see that. So yes, David says, I've joining you for the next few Mellow Mondays, and I'm going to share some investing rules with you. And these are rules which should help you improve your portfolio management. Today I'm going to start with one of the basic ones, which is setting an upper portfolio limit. But before we do that, I'm going to spend a bit of time explaining why I think rules have such an important part to play in people's investing. So it's because of these things called behavioral biases. We all have weaknesses in our decision making, and they're due to how our brains tend to operate. I'm going to run through this very quickly, but in my book I go through this in some more detail. So if this is new to you, then yeah, feel free to pick up a copy of that and check that out. But it comes down to really sort of two what they call systems that function in our brain simultaneously when we make decisions. The first is called System 1, and you might know there's actually a listed marketing company named System 1, and they've taken their name from this this area of behavioral science. And System 1 it's fast, it's reactive, it's always on, but unfortunately it's often wrong about complex scenarios. It's great for making very simple, reactive, intuitive decisions, but it's not very good at making complex, difficult decisions. But because it's always on, System 1 jumps in with immediate answers to problems. Let me start with an example here. So here's a particular problem. And the problem is, in a lake, there's a patch of lily pads. Every day, the patch doubles in size. If it takes 48 days for the patch to cover the entire lake, how long would it take for the patch to cover half the lake? So what your System 1 does when you hear this problem is it sees the number 48. It also probably picks up the word half. And, if you're under pressure to provide a quick answer, your System 1 will jump in, take half of 48 and say 24 is the answer. Unfortunately, that's also the wrong answer. And in kind of tests of this problem, about half of people actually get this answer wrong. The real answer is 47, because if the patch doubles every day, then it only takes one day to go from half covered to fully covered. So if it's fully covered in 48 days, it's half covered in 47 days. So, and solving that problem correctly is what your System 2, as it's called, does. So System 2 is slow, thorough, but unfortunately, it's also much harder to engage. And as we said before, in order for System 2 to provide the correct answer of 47 days, it first had to override your System 1, which has already jumped in and provided the answer, the wrong answer, of 24. And the problem gets worse, in fact, is that you might think that, well, we can simply overcome these behavioral biases, these ways in which our decision-making is flawed, by trying harder. If we try harder to, kind of use our system too, then maybe that will improve our decision making. Unfortunately, that doesn't seem to be the case. We turn to a guy called Daniel Kahneman, who won the Nobel Prize for his research into this area. And when they asked him, has it made him a better decision maker? He said, no, my own decision maker hasn't improved. I'm much better at detecting other people's mistakes than my own. And we see this as a common theme in all sorts of research is, kind of knowing about behavioral biases doesn't improve people's ability to overcome them. And this applies to investing. Investing lives in the complex, the statistical, the analytical system too world. But the behavioral biases consistently will cause us to make poor decisions unless we have a strategy to overcome that. And the strategy I think you can use is creating rules. So although you can't overcome behavioral bias in the moment, where you're likely to be, to have weakness, where you're likely to make mistakes. There's a lot of research done into behavioral biases and where we tend to make mistakes. So if you're going to be irrational, you can put in place a rule ahead of time to overcome those issues. And it's not, without precedent. So in a book called The Checklist Manifesto, a surgeon called Atul Gawande, describes how, pilots, surgeons, highly experienced and specialist people use rules every day to avoid preventable mistakes. And over the next MelloMondays, as I said, I'm going to take you through some of the rules that can improve your investment process. And I'm going to start with probably one of the most basic ones, and that is set an upper portfolio limit. So this is set a limit to the maximum amount of your portfolio that you'll hold in any one stock. And going, kind of taking that further, I think you should also probably set a limit to which you'll hold in any one sector or industry. It doesn't matter if you're an expert in, say, the oil industry. If you have all of your portfolio in oil stocks, even if that's your specialism and you have a competitive advantage, if the oil price goes from $100 to $20, you're going to lose money, no matter how good you are. So you want to limit your amount in any industry as well. And I think you should choose them conservatively as well. So I'm going to explain why I think we often have too large positions in individual stocks. The first is overconfidence. So all of us are likely to be overconfident. 80% of us think we're better than the average driver. And overconfidence means that we'll tend to underestimate the chance of bad things happening and overestimate how much we know, and we'll tend to oversize our positions because of that. The second reason is what's called unknown unknowns. So these are often called black swans. So the idea is that prior to the discovery of Australia, we thought every swan was white. We'd only ever experienced white swans. But as soon as we discovered Australia, we discovered that all these black swans existed. And it's a metaphor for things that are just completely outside our ability to perceive. And I think, coronavirus is potentially black swan. None of us could have seen the effect that, coronavirus was going to have on our portfolios, just 9 months ago. So I'm going to leave you with some advice from a guy called Baz Luhrmann. You probably remember the track. He said, the real troubles in your life are apt to be things that never crossed your worried mind, the kind that blindside you at 4 p.m. on some idle Tuesday. And I think that is a very good reason to always have upper portfolio limits.
Brilliant. Thank you, Mark. And that's just one in a series, so I'm sure you're going to come back. How many more will there be, do you think, Mark? How many rules?
Well, I tried to write, kind of plans from the other day, and I came to at least 15. So yeah, depending on how long you want me, David, I think I could be here all week. Yeah, all year.
All year, I think. Yeah. Okay. Thank you very much, Mark.
Thanks, David.
Right, now we have our new session called The Game Changers. And this is a situation where we hope we can introduce a company that will certainly be in a position or have just announced something that puts them in a position to have a much better outlook for the future. We have somebody joining us who's going to introduce them, which is Simon. Can you hear me, Simon? Can you hear me, Simon?
Yep, can you hear me?
Yeah, we can hear
Yes, can you hear me?
you. Yeah.
Yep.
Great.
Okay, so
Little bit of
9 seconds. I would like to introduce the first company. Hello? I would like to introduce the first company that we're showcasing under the title Game Changers, which is Surface Transforms. They make the best brakes in the world, carbon ceramic brakes, but for nearly 20 years they've been
Sorry, Simon, looks like we've lost you a little there. Anyway, I'm happy to introduce Surface Transforms, and Kevin is certainly on the line ready and waiting to tell us all about it, so I don't think we should have too much of a problem. Surface Transforms, certainly I've known, I think, for about 10 or 11 years, and often seemed like you were right on the cusp of something good, but never quite made it. Maybe, Kevin, you can tell us exactly what's happening right now and whether you think you're on the cusp or whether you're breaking through.
Yeah, I will try and do that. Let me share my screen and take you through a few slides that I've prepared. And as I say, I'm taking up this new slot as Game Changer. So my plan is to give you a bit of a taster in this short slot today. So not spend a lot of time on the detail about the business, but try and focus on why we think we are a game changer and what that moment in time that it happens. And we've got another session, I think, lined up for Wednesday, which is a bit longer. I think it's up to an hour, where I can go through in a lot more detail. So if you like what you see, if you like, and from this taster of why we think we're a game changer, you're very welcome to come and join me again on Wednesday, where I'll give a much more detailed and thorough presentation on the company. So let me try and give a very short introduction to put everything into context. As I've been introduced, the company's been around for quite some time. It started back in the early 90s, and I'm going to try and take you through from inception, if you like, right through to present day, and explain why it's taken so long and why we think we've had our crucial game-changing moment. But as background, we work in the automotive market. We manufacture carbon ceramic brake discs. Just to give the market we are working in is the performance and luxury car market. For those that don't know, brakes are an essential part of every car, and they occur inside every wheel of the car. And I've tried to put a picture there inside the wheels. So there are 4 wheels. So there are 4 brake systems effectively on the car. They all work in unison. They are obviously a safety critical part. They are the part that stop the car. And they are actually a very integrated and complex system to make work. So there's a lot of technology, a lot of engineering, a lot of know-how in making brakes work. And that is one of the dynamics, if you like, of the marketplace and the barriers to entry. That middle picture there just does the breakdown of what that system is. It's made up of 3 components. A brake disc, a caliper, and a brake pad. And when you put those 3 things together, that caliper, the red thing in the middle, has 2 pads slotted in either side, and those pads then squeeze against the brake disc by you pressing the pedal and creating pistons inside that caliper that push against the pads, push against the disc. That forms a friction force, and it's that friction force that reduces the speed and slows down the car. Now, the bit I'm interested in is the brake disc. As I say, every car has brakes on it, and all of them are made out of grey cast iron today. There are some carbon ceramics in the marketplace, and that's what ourselves and our competitor, and there is only one competitor in the world, And they and ourselves offer an alternative to iron brakes, and that is to replace that iron rotor with a carbon ceramic. Now, there are compelling market reasons to do that, particularly for the performance and the luxury car market. And I won't go into the detail, but there are benefits environmentally. There are benefits from a technology limitation on iron brakes and light weighting. There are benefits from the aesthetics and brake reduction and brake dust on the wheels. The quality, the ride, the handling of cars, the comfort of cars is greatly enhanced. And there is actually a lifetime benefit because ceramics don't wear out, whereas you replace your iron rotors regularly throughout the lifetime of the car. And perhaps the most important driver in this marketplace is for automotive, when you're talking about large volumes. It's almost unheard of to have a monopolistic supplier. That's what we've had in this marketplace with a company called Brembo SGL, and the market has been crying out for a alternative, and that's where we've been working, if you like, very hard in the background, and have now become that incredible alternative. Now, comparing ourselves as a product to our competitors, we talk about having a superior product. We've been working hard over that, and I'll go through this in a bit more detail, but we've been working on putting capacity into our new facility. You can't operate without, like driving a car and having a driver's license, you can't operate without having quality certifications, and we've had those for over 5 years. And the other key things are price. We are price competitive, even with the disparity in volumes between ourselves and Brembo. And we have a very secure supply chain and integrated manufacturing site to give our customers comfort that we can deliver. Now, that's a bit of background. Let's talk about why we think we're a game changer. And I'm going to use a couple of models that the automotive industry fits quite well, and we fit quite well too as well. First one is this Rogers technology adoption cycle. A lot of you I'm sure will be familiar with it in terms of how a market adopts new technology. In the early stages, it's the enthusiasts, the innovators. Then you move into the early adopters through to the majority, early and late, and then the latter part of the laggards, and that's the mainstream market. And if you like, you move through that over time, and the volume of people is the vertical axis on that curve. Now, I want to just make that more relevant to our market first of all. And I've distorted that graph somewhat and the bell-shaped curve. And I've also introduced this concept of a chasm or a death valley. And particularly for automotive parts, a lot of companies might start the journey of going through innovation with new technology and a disruptive technology, but making it across that chasm and making yourselves into a game changer and reaching the mainstream market as a hell of a reward. As you can see, that there's a significant difference in volumes, but it's a very, very challenging task, and there are significant barriers to entry, which on the flip side, if you can get over them, are fantastic protection if you're in that marketplace. So how do we fit into that model? Well, I'm going to keep talking about the chasm as I go through. Back in the early 90s, a few scientists from ICI started up the company, 4 of them, and had a kernel of technology. And they effectively went through a very long incubation period with that technology, about 15 years, working in their laboratory, developing a technology that they thought was useful. And that was really the beginning of that tech enthusiasm and innovation. And you'll see as I jump through this, the periods get shorter, but the excitement gets bigger. Then we went into the development phase, and the development phase was really taking that technology and then started to create some products. And like any market, particularly a risk-averse, safety-critical market like we work in, you can't just go straight in and offer that to the mainstream vehicle manufacturers. You have to start in the area where there's the most amount of risk acceptance, and that's in race. So we developed our products and introduced them into race in the mid-2000s, and then we put them into retrofit products of our own that you could upgrade your own car with a superior product that we made. And then we moved into the area we call it near OEMs, but these are specialist vehicle manufacturers that make a relatively small number of cars, but they rely on innovation and new technology to sell their cars for the future. Now that that really allowed us to do two things: generate some revenue, albeit very small, and some cash. But the key to moving out through this development curve and this adoption curve and crossing that chasm is to develop your product and get millions of miles on the road and do lots of field testing. And the only way to do that is to do it through either paying to put it on lots of cars, or to use these subsectors of the market to allow you to get feedback on your product. But it takes time, and it takes a long time to go through that advanced engineering part of the cycle and development. And that's what we were doing between 2007 and 2016, was to going through that decade of advanced engineering and product validation. Now, in 2017, we moved into the industrialization phase. We moved into a new facility. I've got a picture of it there. That facility is about 55,000 square feet. It's based in Liverpool in the northwest. And we started to install capacity. So rather than, if you like, we've moved from research lab to prototype shop, we now needed to start to create a manufacturing facility and industrialize it. And we made a significant investment, circa about 7 to 10 million, to install our first OEM cell 1, we call it. And you'll see from the aerial photo, it's a rather large site, but the cell doesn't take up a significant amount of room. So we have an expandable cell that we can install cells 2, 3, 4, and 5 inside the same building. So the idea was we industrialize it, we make it work on a scale, and then to scale that up even further, we could just replicate cells. Now, we've been doing that for the last 3 years or so, and I'm pleased to say we have OEM Cell 1 installed, and it gives us the capability to generate revenues of about 20 million per annum. Now, during this period, we've also been working through to go into the manufacturing phase, and to do that, you need contracts. You need to be able to supply the demand in the marketplace. So I've just put down here the new contracts that start in 2021, and SOP stands for Start of Production. And so all of these contracts we've won during that, if you like, industrialization phase. In fact, these are the only ones I've put down, the ones we've won in the last sort of 12, 13 months. And they're all starting next year. And we're going to go into this phase where we start to see manufacturing ramp up rapidly. And that will obviously generate significant revenues. And it's this industrialization phase and the contracts we've announced over the last 12 months or so that are the game changers. That is what is allowing us to bridge that rather large chasm for us between the visionaries, if you like, and the pragmatists, and that early adopters into the mainstream market. Now, just to go through that, we announced an OEM 1 contract, and apologies, our customers tend to keep their names confidential. So we have acronyms, if you like, 1 through to 8 for different customers. And that one was for a track car, a value of £500,000, and we delivered that in 2019. Second contract is with Aston Martin, we're the sole supplier for this car, and that's typical. When you get nominated and awarded the contract, they tend to only want to do the engineering once, so they give it to one supplier. We're standard fit, and the lifetime revenues for that is about 2 million over about a 2-year period. And you'll also see a theme here with the contracts that they're growing in size, but they're growing in duration as well. Typically, contracts last between 4 and 7 years. We also announced an OEM 5, again, that's a German OEM, a sole supplier there. It's an option fit on this car, interestingly enough, and that's part of how the adoption works. You'll see it on the top end cars as standard fit, and it will trickle down into the more sort of premium end of the market at the sort of 50, 75 price range as an option fit. This in particular is on the front axle and main braking axle. Lifetime revenues are about 11 million for that over that contract period. And then we announced just about 6-7 weeks ago of, if you like, the final piece of the crossing the chasm and the game changer, which was an OEM 8 contract with a global OEM. Again, sole supplier, standard fit, lifetime revenues of 27.5 million. And when you add those up, we've effectively announced 43 million revenue, 43 million pounds worth of revenue in the last 12, 13 months. That all starts to come in and starts to generate a significant ramp up in our revenues annually from 2021. I will talk a little bit about those revenues, but just to give you a bit of meat on the bone, we've seen revenues of 1 to 2 million over the last decade per year. with these contracts, we'll start to see revenue guidance go up to 2 million right now in 2020, 7 in 21 and 12. And obviously with revenues comes profitability. Now, that is also in the context that as we move through this market, we have a prospective, very exciting prospective contract pipeline of 50 million per year, per annum. Over the next 5 years, we'll see that those come through. And those are follow-on models using the already engineered solution that our customers have now created. And there are also some new customers in there as well. And we must remember that's in the context of what we describe as a £2 billion addressable market for carbon ceramic brakes, which would swap out iron brakes on cars above 75 in all four corners and cars between 50 and 75 on the main braking axle. So that's where we talk about bridging that chasm and the game-changing events that have happened for us. Now, if I try and talk about that in terms of revenues on an annualized basis, during that research phase, we had little to no revenue. During the development phase, revenues were typically 1 million per annum. And we saw that slightly increase because the markets we were working in, the race, retrofit and near OEMs aren't that big. So revenues grew to about 1.5, 2 million. But now that we've bridged that chasm, made the game-changing contract wins, we start to see in the manufacturing phase, revenues start to ramp up very quickly at 7 to 12 with current contracts. As I say, we have installed capacity of 20 and we're scalable going forward. And that's what happens, if you like, if I overlay that revenue onto that model I've been using. Finally, last couple of pieces here. I just want to talk about share price and value to our shareholders. I'm using the Gartner's hype curve here. You can see there's, when we first floated, if you like, in the early stages, there's a, if you like, an inflated expectation. We saw that quickly drop over the years to a trough of disillusionment from shareholders. I think as we cross the chasm and we go through the game-changing status we've got, we've started to see that slope of enlightenment kick in, and we're heading towards that plateau of productivity, and that's reflected in our share price as well. And you can see we had that initial period, which then slumped and has started to grow quite rapidly. So that's followed by, if you like, mapped out with our revenues. And then if I just summarize it, because I'd like to take a few questions. It has been a long journey. We've followed the adoption lifecycle model. We are now realizing our strategy, and that is to be a manufacturer of carbon ceramic brakes. And we're one of only 2 manufacturers in the world that supply mainstream OEMs. We're seeing a fantastic momentum growing, and it's increasing with multiple OEM contracts coming in, and they're multi-year. As I said, the 4 I've highlighted worth 43 million lifetime value, and that's in the context of the prospective pipeline of 50 million per year by 2025. And the last point really is that all of that you've got to put in the context of a potential market, addressable market of 2 billion per year for the luxury and performance car markets. And as I say, we'll go through this in a bit more detail on Wednesday, but there are very compelling reasons why that's happening, and we're very well positioned to take advantage of it. So that leads me on to say there is a disclaimer here that nothing I've said you should rely on, but I'll take questions and say thank you very much.
Great, thank you, Kevin. And yes, with 341 people on the webinar, there's bound to be lots of questions. So I've got a few here. We're never going to get through them all. Everybody on the webinar has had a link sent to them for Wednesday. It's at noon, and you're very welcome to join us. That's one of the advantages of being part of this. You can have a much longer time to understand everything. But here's your first question for tonight, Kevin.
Okay.
Does the move to electric vehicles present any further opportunities or possible concerns?
Well, it's a fantastic question, and I'm glad someone's asked it. So we think electric vehicles are fantastic news for us. We've talked about the mainstream market, but electric vehicles have a couple of issues with their current incumbent iron brakes. One is galvanic corrosion, and brakes on electric vehicles, there are the mechanical brake as I've described, but there's also the electric motors that can slow the vehicle down. And because of that, the brakes get used significantly less. Although they have to be sized correctly in case they need it, they get used less. And that means that because they corrode with water, you can start to see a seizing of the brake where the pad and the disc seize together. Now that's very undesirable on a safety critical part. You don't see that with a ceramic, so it's good news for a car taking on a ceramic brake. Coupled with that, anything lightweight can extend range is good news, and anything that reduces pollution and with brake dust, like the environment where electric vehicles are strong, is also aligned very well.
Great. And do ceramic discs require more warm-up than conventional discs? If so, does this present a challenge too?
Yeah, this is something that is out there as myth rather than fact, and let me bust that myth right now. There is no need to warm up a ceramic brake. They work in all conditions, and they work whether you're just setting off, been driving the car for a long time, whatever. There is no such thing as a dead ceramic brake in the mornings, if you know what I mean, when they're first cold.
Great, that's good news. And the contract that you've announced, clearly very big. Do you feel that there might be any problems executing such a large contract? I
mean, I heard you ask someone earlier what keeps them awake at night. Well, I wouldn't say this keeps me awake, but the implementation and the industrialization phase is clearly our key risk. We manage that risk on a daily basis. We've been working to put the capacity in for some time. Do we know everything? Clearly not, but we believe we've done all the risk mitigation we need to, and it's really about just doing our day jobs, keeping our noses to the grindstone and getting it done. So I'm not worried about it, but we're not complacent either.
Great. And apparently somebody knows quite a bit here about the salt spray test. They say, what is the current position regarding OAM3?
Well, that does allow me to say that we've become realists rather than optimists in terms of what we talk about. So we don't talk about stuff we haven't won yet. So we, in the early years we had to, but now we don't. We've got contracts. For OEM3, I would take that question as part of Wednesday's session because it's quite a detailed answer, and we don't really talk about what we haven't won yet.
Okay, that probably leads us on nicely then to look completely to the future. When do you see the mass EV market adopting CC brakes, and what market share are you targeting?
Can I answer that in twofold? What market share am I targeting? Firstly, we live in the context of a £2 billion market. That doesn't really address the electric market, so it's probably even bigger than that. Well, that's big enough for us to get our teeth into. Let's remember where we are. We're talking about increasing revenue to 7 and 12 million. We've got a facility that can put in 5 cells rather than 1. So we've got enough around us to get to our 50, maybe even higher revenues today over the next 5 years. Where can I see it going? Honest answer is I don't know, but don't underestimate our ambition. We'd like this to be a fantastic business that grows and grows and grows for the next 10, 15, 20 years. So that's our plan. But we're just trying to keep it real and just say, let's get what we need to get done today.
Okay. Anyway, we're really happy that you've come along. It's given us a little insight, and Wednesday hopefully will complete the whole picture. So tune in on Wednesday, and thank you very much, Kevin. You'll be joined, I think, by David, your chairman, on Wednesday as well.
No, I'm looking forward to it. Thank you.
Thank you very much. Thank you.
David.
Okay, our next session is the Investor QQ. And I know quite a few of you tuned in last month for the Investor QQ and really enjoyed it. So we've lengthened the session this month. I can see Mark's on the line and Pamela too. Great, excellent. Well, for those of you who read the program, you'll know a little bit about both Pamela and Mark. If I go first to you, Pamela, we met just over a year ago at one of our physical events. Doesn't look like we're going to have one of those again for a while, but great to see that you're in an investment club as well, just the same as the Stockopedia guys that were with us earlier in the show. The the name of yours is the China Dolls. So I think many will remember that. But maybe just tell us why you came across the name China Dolls to start off with.
Well, we happened to be in a Chinese restaurant when we discussed the idea of setting up an investment club, and somebody remembered the phrase something like China doll to an there was an old phrase about the city and China and oranges, and we just came up with this name of China Dolls.
And have you invested in China at all?
No, we haven't. No, we stick very much to the London Stock Exchange.
Yeah.
And we're not invested. The investment club is not invested in any unit trusts or investment trusts. We just invest in individual shares. So no, we're not invested in China.
Great. Well, anyway, we want to get to know, obviously, you, not necessarily just the investment club, but maybe you can tell us what your own investing style is.
Well, my own investing style really is much more cautious. The investment club is fun. We can we're quite risky. We can go for AIM shares. My own investing style is very much we were in business which we sold up in 2004. So we live very much on our investments. So I tend to look for capital growth, obviously with some dividend, but I think it's better to look for a good solid capital growth company. But as I've got older and I suppose more cautious, I'm very much the majority of my portfolio is in investment trusts, and in that respect I have been a little bit more ambitious. I mean, I've had Polar Capital Global Technology, which has done fantastically, so that's all the sort of tech companies, and Scottish Mortgage as well, investment trusts, which I know has also got a lot of tech companies. But then I've also got a lot in foreign and colonial as a well-established solid investment trust that pays a modest dividend and has increased that dividend every year for 100 years.
Okay, so what overall would you say has been your best ever investment and your worst investment?
Personally, my worst one has been Tullow Oil, which it did very well in the early days, and luckily did take some profit from that. We used to have a ski flat, and actually two of the directors of Tullow had flats in the same block. But anyway, Tullow's been a complete disaster. I suppose as excuse me, as an individual share, Fever Tree has done very well individually. We picked it up in our investment club, but I also bought some personally, so that's done very well. My best performing investment trust has been the Polar Capital Global Technology one, which is up over 100% in 2 years, I think.
That's good. We have had Polar Capital at our shows, so that's good news. Overall, then maybe we can have a little chat with Mark as well. What about you, Mark? What's your style, would you say?
Oh, can you hear me okay?
Yeah, we can hear you.
I'm very much, I think, in the sort of value and contrarian type camp. I've got if I've got a vice, I suppose I'm a bit of a sucker for a story stock as well, and I'm really doing my very best to get out of that habit and be a bit more disciplined and avoid the silly story stocks. But no, I'm value, I'm contrarian, and as a result of that, I usually have to sit very patiently and just be wrong for ages and ages.
And what would you say your best and worst investment?
I suppose the best one, and the one I suppose that that really did it for me was way back in about 2000, 2001. I invested in a company that a lot of people will know of. It's been incredibly accident prone recently, but it was called Sprue Aegis, and I invested on it when it first went on to OFX. So I was an investor there for ages and ages and ages. And I ended up taking part in a private placement. So I really doubled down on it. And again, I sort of sat for ages and ages, and it went absolutely nowhere until it got a pretty much unsolicited bid for it, and that put a bit of a rocket under it. And I was fortunate enough to actually I was effectively forced to sell out of it in order to fund a very long-standing legal action that I got involved in. But it actually forced me out pretty much at a nice high level. And sadly, a lot of investors here will probably know that it's gone on to really struggle recently, and it's been very accident prone recently. But I'm keeping an eye on it with a view to maybe having another look at it at some point. And probably my worst one was I made an unquoted investment, so an investment in a private company in 2007, which wanted to be the very first online estate agency. So no doubt a lot of watchers will note the date, 2007. And sure enough, in about late 2008 or early 2009, it was a bust. But I'm sort of proud and ashamed of that. I'm sort of proud, in a way. We all knew that digitalization of estate agency was going to happen. But of course, it's not always the case that you are invested in the one that is going to do it.
Oh, it happens to us all.
Yeah.
I'm sure I've had a lot that have gone bust. Pamela, you've got an interesting set of books there in the background.
Oh. Yeah, it's just a good place to sit.
Naked Trader, in fact.
Oh yes, well Tamsin recommended that when she came and interviewed us. Yes, it's a great read.
Good. Tell us a little bit more maybe about some of the investments that you've made. How long have you been investing now?
Personally, from the year 2000. I mean, many years ago, I was in an investment club at university. But then, I mean, that was in the early 70s. It was very successful in 71 when the FTSE went up 42%. But the next 2 years, the FTSE actually went down 87%.
Oh my God.
The year after, it was back up again 136%. So that extreme volatility, and the investment club folded. We'd all left university, we were working, and then career, mortgage, family, and then into business. So I had no investments at all. And then in 2000 we started the investment club. So we've been going over 20 years. And then when we sold our business in 2004, we had a lump sum really to live on, and made the decision then to cash in our pensions, and over the 15 years since then have been moving all the money in, or as much as we've been allowed, into an ISA, because I think that's a great long-term investment tool. All your capital gains and all your income is tax-free.
Yeah.
Yeah.
So give us a company that you feel has thrived, if you like, rather than survived during COVID.
In the investment club, we have gone, one that we've bought and we like is Codemasters, because we feel gaming, people have been working at gaming. That's been a good share for us. Privately and in the investment club, Ocado we bought into. because we've bought into it really not for its food delivery, but for its technology. The fact that it's got this automated picking system, which is way ahead of the other supermarkets who still do the picking by hand, and it's sold this technology all over the world. I mean, a little bit of a hiccup at the moment with a Norwegian company that's taking them to court, but we're sticking with Ocado. We think that'll be a good one. And another one that we've done well on and we like is Segro, which is a real estate investment trust which owns and manages warehouses. It has a lot of property around in and around Heathrow, but it also has some in Germany, France, and Poland. Amazon use some of their warehouses, so that's a company that we like, and it's done very well.
Yeah, warehousing certainly seems to have kept with the game. And games, I mean, you mentioned there, I mean, so many are at home. They spend time more on their gaming than they probably do officially at work now. So Games Workshop, a company that I've been in for years, they've really been doing well through all this. Yeah. What about you as well, Mark?
Well, I suppose I could mention the one that I bumped into you at recently at the AGM, Tandem Group. Bicycles, and they also describe themselves as wheeled toy suppliers, bicycles and wheeled toys. But yeah, bicycles seem to be going great guns at the moment, and the impression I got from them at the AGM was that if ever they had a problem to solve, it's that they couldn't get hold of enough of them. Yeah. But yes, that's been a good one, and it was nice to bump into yourself at that AGM as well, David.
Yeah, only to let everyone know, it was officially an AGM. It was a sort of a capital markets.
I beg your pardon. Yeah.
A sort of a show us around, show us the products. Yeah. And every single product they did was sort of almost going out of stock, and yeah. Golf clubs, even everything was just being. Well, you'll know that, Pamela. I think you're a golfer, aren't you?
I am, yes. I know it's hard to get a new golf trolley at the moment.
Yeah, I think, well, they do golf trolleys and they do golf clubs. Ben Sayers, that's their brand in golf, which is at the low end. But of course, people are taking up golf at the low end. They don't want to spend £2,000 on a set of clubs to start off with. So yeah, going well. You're right there, Mark. And what about your investment journey, Mark? You started young.
Well, I suppose I did start young. I mean, before I set up the Glee Clubs, which is the group of comedy clubs which I own, I started off actually in corporate finance for a merchant bank called Brown Shipley. But I started in 1990 and I ended in 1994. And when I started, there were 35 people in my department, and when I finished, there were 4. So that's the story of the early 90s recession. And the reason why I set up the comedy clubs was actually because I wanted to get the hell out of the city, because everybody was being made redundant. And I thought I would probably come back to having a proper job in banking after 3 or 4 years, but I never really looked back. But ever since then, I mean, I was a dabbler all the way through. It's only really in the last 3 years that I've been trying to do this kind of semi-professionally. You might be aware that the Glee Club spent 6 years fighting with 20th Century Fox over the trademark of the name Glee. And I won in the High Court and I won in the Appeal Court. And 10 days before we were due in the Supreme Court, Fox settled with me. And that was in late 2017. And I'm not allowed to say much about the settlement, but it gave me a sort of a nest egg to kind of go semi-professional at this game. So I got myself a Stockopedia subscription and sort of took it really properly seriously, as opposed to half seriously, from about the end of 2017.
Yeah. I must say, I don't know. Have you got a Stockopedia subscription, Pamela?
Well, no, we haven't. We have thought about it, especially after we've been to the Mello presentation. Yeah. But although I think perhaps listening to the early part of the program, maybe it's something we ought to be doing.
Well, I'm sure Ed's still listening, and he's on the bash panel at the end, so he'll be sending you a trial, no doubt. If you're...
All right. Okay. Well, I think we are interested. We're definitely listening to one of the other speakers. We definitely tend to jump into things. I think, you know, we have a meeting and we do a pitch, nothing like the pitching that the Stockopedia recommended, but we seem to have our sort of our ear to the ground. Is that the word? It's how we picked up Ocado and Codemaster. We're still really keen on CMEC Atlantic Energy, which we had the presentation when we came to Mello. Yeah. And we thought it was so impressive, and we've hung in there. We had it when it was Atlantis, I think was its first name. So we've had it for years, and we've even bought a little more. So we have great faith in the company, and we hope it'll come good eventually.
Yeah. Well, at some point we might get your whole team in to talk about things just like Ed and Oliver today. But I mean, I must admit, I mean, I don't want to plug anyone, but I think a lot of the investors use Stockopedia, and you'll find in the bash we show their data, and you know, it is a popular way. Some feel they really sort of made it to assessing things when they use Stockopedia. But anyway, one thing for you though, Mark, while you're mentioning Glee, yeah, I think I know you're not a comedian necessarily yourself. Doesn't mean you can't give us a nice joke that you've heard recently.
Oh dear. Well, the only thing that I was going to say was that if there's one thing that lockdown has taught us, is that, you know, everybody jumped headlong into doing online comedy gigs. Literally, you couldn't move for doing online comedy gigs, and we did them too. But I don't know if you've noticed, there's an awful lot fewer of them now. Now, I mean, I was a little bit skeptical of them at the time, but I wanted to sort of jump in, and I didn't want to get left behind. But the truth is, you know, laughter is such a communal thing. There's something incredible about the peer pressure of laughter. And, you know, after 3 or 4 months, a lot of comics actually didn't really want to keep doing them either, because they realized that, you know, the good old traditional setup, feed line, punchline just wasn't working without an audience to work to. So they've all died a bit of a death. I don't know. As for me, you know, my friend always says to me, if you're in a hole, stop digging. Sensible guy, terrible archaeologist.
Okay. Right. Well, I think that's just about covered it. Thank you to both of you for coming along this evening. We always enjoy learning and hearing how other investors do it. And maybe at some point we'll get you both back, and you can tell us a little bit more. But here we are. We've now got our next presentation. This one is an IPO, and we do like to bring the IPOs here because in many ways IPOs are unknown quantities, and the only way investors can learn about them is if they hear and see it and get a presentation. So if we get it before it comes to market, that's a great time to hear things. Anyway, we have both of the presenters from Mailbox, Richard and sorry, I've lost your name on the screen there. Tony. Sorry, Tony.
I do answer to Kevin.
Oh, excellent. We'll call everyone Kevin tonight, and I'll have no mistakes made. As far as I understand it, you've probably done quite a few presentations, but I would just like to tell everyone that there is a disclaimer to start this, because you are on the road, as it were, promoting Mailbox. But for those who live around the country, Mailbox is one building, I think, in Birmingham that you want to tell us about.
Yeah. So, I mean,
over to both of you.
Well, it's a bit more than just a building. So what we're going to do, I will lay the background to the listing, and then ask Tony to tell everybody about the Mailbox. So the Mailbox is the first ever listing, a historic listing on a new stock exchange called the International Property Securities Exchange. And this new stock exchange has been designed and is regulated by the FCA and is a fully market-made exchange. It has been designed to allow the general public access to buy directly into major commercial real estate. Rather than having to buy through a property company which owns lots of assets, it allows investors to build their own property company effectively by buying into existing buildings. The mailbox is the very first thing to be listed on it. The reason why this is so important is in the post-COVID world where we're going to have negative interest rates and certainly 0% interest rates for a considerable period of time, is real estate is one of the asset classes that gives a very focused dividend stream. And I'll just leave everybody with this thought. You know, many people buy shares so that they can have a dividend stream. But in fact, if you take a company like British American Tobacco, it has to pay its rent before it pays a dividend. Well, that's true of any company at all. So real estate is right at the top of the cash flow waterfall. So IPSX is giving the general public through their ISAs and their SIPs and just through their personal money, the ability to invest directly into real estate. And the first listing is the mailbox. And Tony will just give you a little bit of background to the mailbox itself.
Thank you, Richard. Good evening, everybody. Some on this call may indeed know the mailbox. As its name suggests, it was once the Royal Mail sorting office in central Birmingham. It's about 5 minutes walk from New Street Station. And in fact, little known, there is a tunnel that goes from New Street Station directly to the basement of the mailbox, through which trolleys used to pass. How very quaint. It's 4.8 acres of land. And in the year 98, 99, 2000-ish, that facility was closed and the property was redeveloped, and it was converted from a sorting office into a enormous mixed-use asset, a complex. I mean, almost a village in its own right. Some 3,000 people work in the mailbox. And it was principally offices, a car park, the largest office car park anywhere in Birmingham, a precinct to the rear, which is food and beverage that fronts onto the canal, and at the time that it was redeveloped in 2000, a retail offer of about 120,000 square feet in total, anchored by Harvey Nicks. The whole complex is 690,000 square feet. That includes the car park. So expressed as a proportion, you'll see that the retail component was quite small. That whole property traded in 2011 and was bought by a real estate private equity business called Brockton Capital. And over the 8 years or so of their ownership, they invested roughly £50 million of additional equity and debt into improving the property, both structurally and cosmetically. Structurally by putting a roof over what was effectively an open air mall, which seems odd that the original developers would have done that because it rains quite a lot in Birmingham. So that all got enclosed. Cosmetically by improving the appearance both of the common areas, which today are really quite luxurious, and also investing very heavily in two large-scale office repositionings where two major new lettings were undertaken during their tenure. Such that today, after the asset was acquired by M7 in December of last year for a little over the listing price of £179 million, which is the offer price of the shares in Mailbox REIT, that asset today in a market which has very limited office supply, there is a vacancy rate in central Birmingham of about 2.7%, is being repositioned by M7 to convert roughly 60,000 square feet of what used to be prime high-end fashion retail, which, as everybody on this call knows, has been badly cannibalized by the internet, and converting that to add to the office stock, which today is fully let. And we're pleased to report that through the lockdown and through the COVID period, the offices and the car park have paid 100% of their rent. That isn't true, it has to be said, of the retail and the F&B, and rent concessions have been granted. But the 5% dividend, which is on offer to investors, which we fully anticipate through the implementation of the business plan, i.e. the conversion of retail to offices, will increase that dividend from 5% to 6% to 7% and on to 8% over the course of a plus or minus 3-year execution of our plan. So that today, at an offer price of 179 million, that is below the replacement cost of the asset, i.e. you could not build a 690,000 square foot facility for £273 a square foot, which means effectively investors own the land for free, with £50 million having been spent by the former owner, where the rents in the mailbox are at least 30% less than the prevailing open market rental value for grade A offices in central Birmingham. And that's really important because in a post-COVID world, if you don't have contemporary and affordable space on offer, you are not going to be able to mop up the latent demand that exists. And indeed, there will be many organizations in central Birmingham where technology, the education sector, media, creative and financial services are all massively represented in a roughly 20 million square foot market. So we have affordable, reversionary, long dated leases. There is an approximate 13-year weighted average unexpired lease term, a strong and achievable asset management plan, and all of that against the backdrop of the previous owner who spent a cheeky £50 million improving the property, which this new company, Mailbox REIT, will be the beneficiaries of.
So if I can just recap, we will start with a 5% dividend. My name, by the way, is Richard Croft. I'm the chairman of M7 Real Estate, which is the company that currently owns the mailbox and will be the manager. Two things that you need to know about M7's involvement in the mailbox. When we list this, we are going to keep a circa 46% share in the mailbox because we believe very much that it is going to increase in value. I'll come back onto that just in a second. And also, we believe in it so much that we have decided that for the first 2 years, we will put our fee, our management fee, behind the dividend. What that means is if we don't hit a 1.25% dividend per quarter, we will waive our fee. Now, that's not quite as generous as it sounds because obviously we own half the company, so we'll be paying half the fee ourselves. And of course, the other thing to bear in mind, most importantly of all, is that, as Tony explained, 70% of the rent comes from some undoubted governance and who've paid 100% all the way through the crisis and make up of the office tenants and the car park. For those of you who might be interested, the mailbox is the home of the Archers, sort of iconic, important building, and is the BBC's headquarters in Birmingham, as well as being the home of WSP and Advanced Business Software Solutions to major companies. We see the opportunity to convert the retail, and we're in the process of doing this, much of the retail into new office accommodation that is ideal for the post-COVID environment because it's industrial, it's high ceiling space and access on the ground floor. And if you believe, like I do, that the primary impact of the pandemic as it passes over the next 12 months is that the mass transit commuter is going to be impacted. Having the best car park, as it were, I'm sort of claim that I thought I'd ever make, but having the best car park in Birmingham and the best car parking ratio for your offices is something that's going to be very good. The thing about the mailbox, though, it is the beginning of what we hope will be an investor revolution, in the sense that we expect many, many more buildings to join the exchange, and we expect many more builders to join the exchange, and all you investors will have the opportunity to say, build your own portfolio. I've been asked two questions. First of all, how is the potential conflict of interest managed when the investment manager owns 46%? We will be the largest shareholder. We think that that's alignment, not conflict. What's good for us is obviously very good for shareholders. So in fact, we'd say that if a manager had no interest in the building, that's when a conflict ensues, because we are not managing for our fee, let me assure you that. The £55 million exposure to the mailbox on our balance sheet, we have to make that grow. So we see that very much as alignment and a selling point.
Richard, may I just top and tail that comment as well? Obviously, this is going to be a public company, and there is a board, a three-man board, made up of three elder members, if you will, of the real estate industry, sophisticated, intuitive, curious, pokey people whose responsibility it is to look after the interests of the shareholders. And once M7 falls below a 20% shareholding in the mailbox, their management contract can be terminated without cause by the board.
Thank you, Tony. Two more questions that we've been asked. Somebody's asked, may I ask two questions? What kind of turnover has there been in commercial unit tenants, especially retail? Quite high. That's one of the reasons why we're getting rid of a lot of the retail. And then the retail on the upper floor, we will be, over a period of time, reducing and turning into what we call amenity space. So things like doctor surgeries, life sciences, which are amenities to the office tenants. We've had pretty strong interest since COVID-19. We've kept, we've kept the office rent collection at 100%. And we've actually done 3 F&B lettings since the start of COVID-19, which were exciting to developments, as we've got rid of chain restaurants and replaced by high quality restaurants, local restaurants in Birmingham, which will perform well post the pandemic. And we've also, we have also got a lot of interest in the vacant office space that we have, which we're just developing. I've got to be a bit careful about how much I say about that, because obviously this is going to be a public company, but we expect to make an announcement about that in the not too distant future. Kevin Taylor has asked, what are the advantages of listing on IPSX rather than LSE? Quite simply, IPSX is designed entirely for the real estate market. So the real estate market, which is the largest industry in the world, I mean, it is real estate is in every part of our life. And we, as an industry, don't have our own capital market. So IPSX, we hope, will be a global thing in due course. And it is designed entirely for the real estate market. And we're hoping that assets that are listed on there, or companies that are listed on there, won't be buffeted in the same way that when somebody sells off the FTSE, lots of real estate gets dragged with it, perhaps inappropriately. We're hoping that individual assets, we think very much, that individual assets will perform according to their performance. So we think that IPSX will make real estate liquid. And so you've got to trade on your phone just like you are on London Stock Exchange, but at the same time will be less volatile than the major stock markets, as there should be less what I'm going to call quantum trading. People will be invested directly into these assets because of these assets.
Richard, may I also add transparency? So transparency both as to the asset which you are investing in. The prospectus or the mailboxreit.com will take anybody who might be interested to more information about that asset than you could wave a stick at. And also, and really importantly, to transparency as to cost. If you are a shareholder in any one of the listed property companies on the FTSE or on AIM, or indeed if you own shares in or units better in the open-ended retail funds, the costs associated with the management of those portfolios, and indeed the costs associated with the management of the management, are extremely high. And in IPSX, that is not the case. You will see what the costs are, and they are literally a fraction of what might otherwise be being eroded from the net position of FTSE REITs.
Gavin has asked the current building rent and 5-year out target. So currently the net operating income of the estate is £9.3 million, and we expect to grow that to close to 13 over the next 3 years. And if you visit our website, www.themailboxreit.com, there's everything you could possibly have ever wanted to know about the mailbox, but we're afraid to ask, is available there. And if anybody has any further questions, we'd be happy to.
I've got one for you both, if there are no more coming up on the screen. Do you plan at some point to maybe have mailboxes in lots more cities?
Oh, for sure. Yeah, absolutely. So, you know, there are plans to put, you know, when the mailbox is listed, there are many more buildings that are being prepared for listing. And, you know, and it is our hope that this becomes our hope is, you know, we consider it a great British piece of innovation, you know, a new market, a new capital market, which will allow investors to invest directly in major commercial real estate and get to the types of investments that historically have been the preserve of the enormously wealthy. Because if you think about it, you know, you can't just go and buy the mailbox if you're any of us, because you need 180 million pounds. You know, so the Shard or any other building that might appear on this exchange. But the fact that you can buy a few £1,000 shares in it and have direct access and direct ownership, I think is a hugely encouraging capital markets development. Somebody's asked,
and by and large, a higher dividend than you might otherwise achieve elsewhere in the sector.
Absolutely. And Martin Helm has asked, is the funding to replace existing debt? Yep, when the listing closes, we will raise enough money to reduce the Deutsche Bank debt from 120 million that is there at the moment, with the West being in 7 equity, to just sub 70 million pounds, which Canada Life are providing. So we will keep gearing below 40% LTV, so it's a, you know, a secure, sensible, and not over-levered investment.
So presumably you'll go looking for other buildings where maybe they have got into difficulty, or where they...
So the exchange is just like the London Stock Exchange. We don't go looking for, I mean, I'm also director of the exchange, just to declare.
Yeah, I was wondering why you mentioned that. Yeah.
So the exchange itself is just an exchange, but are we expecting the real estate industry to embrace it as a technology and as a capital market? Absolutely, 100%. And you say we expect there to be a large inflow of new assets to be listed over the course of the next 12 months.
Including, if I may add, and this is a slightly impudent or even audacious suggestion, but the open-ended funds, which today probably house £5 or £6 billion institutionally managed as they are of commercial property, and which have been in the crosshairs of the FCA and the Bank of England, because as they've increasingly had to gate in order to protect a run on those funds, though that structure is outdated. And over the course of the next few months, maybe years, we fully expect, or I personally fully expect, there's no we attached to this, that those open funds will transform and become the genuinely liquid, listed investments that individuals can own a piece of a property or a small portfolio properly managed with transparent cost.
One more question there. I don't know You've got one more question about lease surrenders, but I don't know how deep you can go into that.
No, I can't, because that's in the prospectus. So as long as it's in the prospectus, I can answer the question. Have we contracted lease surrenders of all the retail, not all the retail tenants, but all of the retail tenants on the lower ground floor? Yep, we have dealt with the lease surrenders there, and we will start work very soon on the conversion to office. And as I mentioned, so this is specific to Dave Royal, as I've mentioned, we are already in talks with a number of potential occupiers and hope to make an announcement on that relatively shortly. Martin Helm has asked, what are the listing costs on the exchange? They're slightly more than the London Stock Exchange, but one of the reasons for that is obviously this is dedicated to real estate. Full details of that are in the prospectus, but interestingly enough, the exchange provides rather more services than real estate does. It's worth noticing that the entire value of the real estate universe on London Stock Exchange is only 50 billion. And there's a lot of money that's on your bank account, but in the grand context of things, you know, the entire UK listed real estate market at the moment is only 50 billion, which, you know, put that into context, is 1/40 of the value of Apple. That's the whole industry. You know, so there is a lot of upside to come from real estate in terms of what IPSX can deliver.
And how long is the IPSX?
Sorry?
How long has that particular market been going now, the IPSX?
Well, I mean, so the journey started 5 or 6 years ago. We got regulated as a regulated investment exchange. So it is a fully regulated exchange last year. And the first listings of Mailbox has taken a bit longer to come to the market. There's been a small pandemic issue, which is sort of...
Yeah, true. Maybe in a year or so you can come back to us and tell us how it's all going, I'm sure.
Well, I would love to come back and tell you how it's all going, because I expect it will all gone very well.
Great. Well, we've got 330 on the webinar at the moment. So could you just leave it by telling us how, if any of them want to obviously buy shares and join the listing, how will they go about it?
The best way is to visit the website, which I will speak very, very slowly. And the website address is www.themailbox, and obviously you can spell the mailbox, REIT.com. So, you know, if anybody wants to look at it, please visit that website, or Google M7 Real Estate. We're quite easy to find, and we'd be very happy to receive a phone call.
Great.
Or your brokers or intermediaries will also be able to make applications on your behalf.
Excellent. Thank you. Thank you, both of you, for coming to tell us all about it. We'll watch it and take it with interest. Great.
Thank you very, very much for your time. It's very much.
Thank you for having us.
Thank you. Thank you. Okay, our next session is with Steve Clapham. Quite a few of you know Steve and have met him at our events. It's an accounting red flags that he throws up. Hello, Steve.
Hi, how are you doing?
Great, great. Lovely to see you got blue shirt as well.
Is it compulsory? Not allowed? I didn't know. I wasn't briefed in the...
Blue is the colour at the moment with Everton top of the league. But that's my excuse.
Oh, I see. Sorry, I was unfamiliar with that. So...
Oh, don't worry. You don't need to be. Steve, you've got probably another red flag for us, have you? And maybe a tip on something you've picked up over the last few weeks?
Well, I'm actually just going through, and can you see my screen? Can you see the red flag on the screen?
Yeah.
So I'm actually just going through a presentation I've done before. And what I've done is I've interspersed that with a series of investing tips, which is from a blog that I've done a couple of months ago. And so what I thought I'd talk about today was working capital ratios. And quite interesting, I did a podcast this afternoon. It was kind of weird because there was somebody from Hong Kong, somebody from New York, and me in London. So there was a span from 9 o'clock in the morning to 11 o'clock at night. And we finished, they said, what tips do you have for private investors? And I thought, there's 3 things that private investor you should do to avoid pitfalls. One is working capital ratios, one is margin comparisons, and one is cash flow. And we're going to cover all of these in the next few weeks. So let me go on by telling you, well, actually, most of the people have been on this before, so you probably know who I am. My background is I was a sell-side analyst for many years. I moved to the buy side as a partner, head of research at 2 very big hedge funds. You can find me here. Please follow me on Twitter. We have an online training school, which you can find on our website, behindthebalancesheet.com. More importantly than that, what you should do is go onto that website and sign up, because we've got a fantastic resource, which we've called the Club, where there is a huge amount of material. We've just added another 20 fund letters from Q3 2020. We've got 100 from Q2 2020. We've got a load of stock research, and we've got about 1,500 articles. And just to finish the advertising, my book, The Smart Money Method, comes out on November the 24th. You can see it also on my website. And David, you're, the guys here haven't been trying hard enough, because I actually found that I was listed. I was actually quite excited. I found that I was listed on the top 100 investing books, but sadly I'm only at number 82. So please all go out and order the book. If you can name 80 investment books, you'd be doing quite well. So let me talk about working capital ratios, because this is meat and drink to the forensic accounting community. And if, like me, your kids eat Kellogg's cereal in the morning, you will think that Kellogg's is a trustworthy brand. And indeed it is. You don't need to worry about feeding your children Kellogg's cornflakes. But the shares are less trustworthy. And what I've just done here is I've shown you the trade receivable days. So this is simply the debtor days divided by the sales times 365. If you want to be really cute, you can multiply it by 366 in a leap year. I don't bother doing that. But this is the quarterly numbers. And you can see it's quite a noisy trend. I like to look at the quarterly numbers because I like to look and see if there's any seasonality in the trend. But I pay more close attention to the year end, to the Q4 data, because I've found that it's in Q4 that people tend to cheat. And the reason people cheat in Q4, very obvious, that's when they get paid. So that's when the CEO and CFO collect their bonuses. So that's when they're particularly cute about making sure they've met the numbers. The interesting thing about this chart is that it is a 16-year chart. And when I drew this chart, this was the longest series I could pull off my system. And the reason that I take such a long chart is very simple. I'm zooming out so I can see the trends much more clearly. And you can see that that trend of receivable days increasing is very clear. I've cheated slightly because I've cut off the y-axis just to make it more, to highlight it more, to make it clearer. But this is a very strong upward trend, and it is just one of a number of tricks that Kellogg's is doing. I like to look at receivables and I like to look at inventory, and I'm going to show you Patisserie Holdings. Now, I generally tend to calculate inventory days in two ways. I tend to look at inventory days versus sales in order to compare one company with another. And I tend to look at inventory days versus cost of sales when I'm looking at a company versus its history. And you can see there's not a huge amount of interest in these numbers here, but when you look at the inventory days versus cost of sales, it's getting a bit more worrying because you've got quite a lot of inventory days here, 90 days. And what I then like to do is I then like to look at the breakdown. And you can see here, it isn't only 200, well, still 299,000 pounds of finished products, which is a bit of a concern because you wouldn't want to eat a 90-day-old croissant, obviously. But the point is that most of it is in raw materials and consumables, 5.3 million. So at this point, I'm thinking, well, it's a very large number, but maybe there's a reason behind that. maybe companies that have bakeries, that maybe there's something in the baking process that consumes a lot of consumables. Maybe there's some oddity about the length of time you need to store raw materials. So I'm not an expert on bakers or bakeries. So very simple, what do? I look at another company that does the same thing. So you can see here that the revenues in 2017 were 114 million pounds. And you can see quite clearly that the inventory totaled 6 million pounds, 5.3 million of which were raw materials and consumables. So what do? Very simple. I pull off the accounts for Paul UK. And we live in the UK, which has got the best possible system for disclosing company earnings, because even the unquoted companies have to file accounts. So Paul UK, parent is in France. You can see that it's got 35 million pounds of turnover. So it's broadly speaking about a third the size of Patisserie Valerie. Stocks, £250,000. So the turnover is 1/3. The stocks are 5% of Patisserie Valerie. It is impossible for there not to be something wrong here, right? And what the auditors were doing at Patisserie Valerie, I don't know, but surely they should have checked the value of the stock. If you want to cheat, if you want to fake your profits, the easiest way of doing that is to fake your inventories. So the auditors were asleep at the wheel. Let me just go on to the investing tips. And investing tip number 2 is liquidity. And you're all going to go, oh no, he's going to yawn on about liquidity because that's a thing for institutional investors. And of course, it is incredibly important for institutional investors. There was a young analyst at a very big and very famous hedge fund who pitched Sotheby's. And he was very disappointed when the principal and founder of the fund, who's one of the most successful investors in the UK and indeed anywhere, instantly rejected it simply because of liquidity. It would have taken them months to acquire a position of any size. And once they'd acquired it, they wouldn't have been able to get out. But liquidity is also important for private investors. There are a number of reasons why small caps are often cheap. There aren't as many small cap funds around, so there's less opportunity for them to be moving stock around. Fewer larger funds today want to have illiquid holdings. There's a legacy from the Woodford days. There's less visibility, reduced analyst coverage. MiFID II is reduced analyst coverage across the board, but it's even worse at the smaller end of the sector. And sometimes there aren't enough interested private investors in certain sectors. And the reason that liquidity is so paramount is you do need to be adequately compensated for a number of risks. So one of the risks is that things don't change. The company does well enough operationally, but not well enough that the numbers become big enough to attract institutional investors. So it's possible you may see the stock go up, but you won't get the re-rating that you're looking for, which will allow you to make the really great returns. Or the liquidity problem stays with you, and then what do? You either can't get out or you have to accept a discount. You know, many stocks are susceptible to sharp falls in an economic downturn. Some people will look to sell and the buyers aren't there. And, you know, the stock has to fall until it finds a level. If a stock fails to deliver, there may be just as much downside for a cheap share as for a more highly valued business as investors dump or reduce their positions. Obviously, these problems will correct themselves over time, but I think many investors don't price these risks adequately. And quite interesting, we were talking about surface transforms. And if you look at surface transforms, one of the very interesting things you can see on this chart, so this is a chart from Sentio, and full disclosure, surface transforms is a client of Hardman. I was involved in one of the original fundraisings for the business some years ago. But you can see that the volume down here has been very, very low. And when you look at it today, the volume has picked up. And this is, I'm not singling out surface transforms just because we happen to be talking about it. But the issue when you're looking at liquidity is you mustn't just look at the most recent period. here's a stock that's doubled and its volume's gone up. What you've got to think about is liquidity isn't a function of the last month or the last 3 months. Liquidity is a function of a much longer period. So that is probably all I want to say today, David, because you've got a Mellow Bash coming up, and I think people are much more interested to listen to that than they are to listen to me. But thank you all very much for having me, and I will see you next time.
Thank you, Stephen. And I think I ought to mention again that annual pass holders, of which we've now got over 200, they will be able to obtain a discount on your winning stocks course.
Oh yeah, sorry, I forgot to say, and thank you very much for bringing that up. So David called me at the weekend and said, you know, can we not do something for the people that bought pass? And I said, absolutely. So if you've bought an annual pass, or if you still buy an annual pass, you can get 30% off our How to Pick Winning Stocks course, which will take it from £369 to, my arithmetic's not brilliant, but around 250 and a bit. And it's a really good course. And if you want to learn more about it, just visit my website, behindthebalancesheet.com. And we will do a different offer for the people that haven't got an annual pass next month. Thank you.
Great, excellent. I'm sure as a forensic accountant, your arithmetic will be excellent, Stephen, but you don't want to be admitting that it's not. Anyway, that's for sure. Anyway, great, here we go. This was voted the favourite session of all in the September Mellow Monday, and it's fairly obvious why. We like to analyse a few companies and find the good bits, the bad bits, anything that we think doesn't add up, we'll try and find it. And if it looks really good, we'll tell you all as well. What we do is cover each company for about probably about nearly 15 minutes. So we like to lead off one of the investors, or fund managers and an analyst we have with us. No Paul Scott tonight, and Alan both been given a night off, but we have with us Melwyn, who hasn't appeared before with us, but it's good to have you, Melwyn. I think most people know Ed as well. And Leon, you're back with us, which is great. So excellent. We can look at each company and we then give a verdict on what we think, whether it's a buy, avoid, sell or hold. Plus our new feature we added last month to balance up the weighing scale, as it were. We have load up the truck, which is obviously even more positive. It's a strong buy. Sounds good, but anyway, that's how we do it. And which company should we kick off with? Should we look at one that's been a popular company of probably the last few months, really? One that came to my attention only about 6 or 7 weeks ago, but it's certainly a bulletin board favorite, and that's Novosit, which is one that you're going to tell us all about, Leon, I think.
Yeah, and I'm going to share with you a presentation, a short presentation, I hasten to add. Right, can you see that?
Yeah.
Yep. Okay, so we've been going through an awful time in most of our lives. I think everyone's probably knows someone who's had COVID, and some people who've obviously know people who've passed away, and it is a very sad time. It seems almost inappropriate to be talking about the success of Novosit, but at least they're helping to provide part of the solution and hopefully getting on top of this COVID pandemic. So Novosit was a very small company until the start of this year. Their revenues last year were about 13 million euros. They made a small EBITDA profit, but a €2 or €3 million euro loss before tax. The PCR business, the polymerase chain reaction business, that was the smaller part of the business until the start of this year. But this really has come to the fore during the current crisis. This is not a great slide, it's a bit blurry. This gives you a very quick timeline. There's been a
a reverse takeover here. In the past, there's been some acquisitions, including the acquisitions of Amiga Diagnostics infectious business in 2018. I think we're talking about Amiga in a while. But really, I just want to talk about what's been happening this year and to go through the key bits of news that have come out. The first mention of a new COVID test was actually in a trading update the company provided in January the 28th. I hadn't heard of Novocyte at that point, and I didn't continue to hear about them for some time afterwards. But less than a month after that trading update, they released a further announcement saying they'd launched the first CE-marked COVID diagnostic test. And within another month, they announced an order from Public Health England. And in the same month, the FDA gave them emergency use authorization. They've been involved with AstraZeneca and GlaxoSmithKline to establish the Lighthouse laboratory in Cambridge. And they've been ramping up the supply of their tests. They reached 4 million in April, and we're developing capacity for 8 million. And towards the end of April, they announced their first contract with the DHSC, and that was to supply the NHS with 228,000 tests a week. So something like 1 million tests. So about 25% of its then capacity was going into the NHS. And then they subsequently, in June 18, launched 3 new products to support COVID testing. Now in July 13, they produced a trading update. And I just want you to remind yourself of the numbers that we talked about this company historically. But in that trading update, they announced their results for H1, which were revenues of 72 million euros and an EBITDA of 45 million euros. Sorry, that slide should say 40 euros, not pounds. So phenomenal growth. And they also pointed to the fact that in June, revenues had been 25 million euros. They went on in that month to announce a 2,000 patient trial for what's called near patient testing in London care homes. And they produced a list of 5 product initiatives that they were hoping to launch in the coming months. And as we'll see, they've been really true to their word. They've delivered on those promises. They've actually released those products in a timely fashion. The first of which was the launch of a CE-marked Winterplex respiratory test panel. This helps to differentiate between COVID, flu, and SRV. That's going to be very important as we enter into the winter months. Although this is a French and British listed company, they hadn't been able to sell into the French health system because Novocyte's test was a 1-gene test, and the French and some other countries, including India, required there to be 2 genes. I think the evidence seems to suggest that you only need one gene, but these countries wanted added assurance. And in September, on September the 17th, they announced their interims, which were slightly better than the update. The EBITDA was 49 million, but they also gave their forecasts through to the rest of that year, and they said they hoped to do 150 million, and they thought EBITDA was 100 million euros or more for the current year. Now, remembering that in June they did 25 million euros, that forecast seemed pretty low. And again, I've got a feel that this company likes to under promise and over deliver. Now, at the end of September, they launched their COVID-19 antibody test. But on the same day, they announced something very important, and we'll go on to look at that. That's a second contract with the DHSC, and that's for their PCR instrument platform and their COVID testing kits. And the phase 1 of that contract is valued at £250 million, and that's likely to be earned within a 24-week period. And most recently, they announced an earnings accretive acquisition of a company that makes their instruments. So let's just go and look at this contract, which was announced on September the 29th. I've already touched on the fact that they have this study for near patient testing within care homes. And this is the first example under this contract of their near patient testing approach being used at scale across the NHS. And the reason why it's interesting is that unlike the turnaround times for the PCR tests that are being done in these big laboratories, here we have a chance of doing turnaround, tests with a much quicker turnaround, just 60 minutes. And that's going to be very important in care homes and in many NHS settings. It involves the deployment of 300 Q16 and Q32 instruments and the related kits and the support for an initial 14-week period, with the potential for that to extend for a further 10 weeks at 100 million. But that 100 million will depend upon the amount of reagents that are being used by the NHS. And then there's a phase 2 to this contract, which involves another 700 instruments, which could potentially be taken up by the NHS, depending on need. And that probably would come through in the early part of 2021. So, you know, a very significant deal, especially because at the time of this announcement, the market cap was something like 300 or 400 million, 350 million pounds. So this is the share price graph of the company. This company was trading at 6 pence last year. And I think the cheapest price you could get into it in this year was about 20p. I've had many dreams of the thought of having been able to buy it at 6p or indeed at 20p. I'm sure other investors have. That wasn't the case, sadly. But what's interesting here is that the share price has had this initial massive ramp up from 20 odd pence to about £5, and then it sort of drifted for a long time downwards. The key announcements were treated in a very muted way. So the first one, the trading update, almost no reaction. You can see the price actually fell on that news. I bought soon after, and then when it gave its financial year forecast, again there was a bit of a movement up, but not much, and I was able to buy soon after the open there before the move up. Now, unfortunately, you guys are in the way of the rest of the graph. Right, I've moved you on my screen, but on the announcement of the second DHS contract, again there was a little move up, and then it fell back down again. In fact, if you look at those three announcements, the first one on the 11th, so on the 13th of July, the shares opened up at £2.67 and closed at £2.70. That was on the trading update. In the middle of September, after the financial forecasts for the year were released, the shares opened up at 370 and closed at 380 on that day. And when they announced this huge contract with the DHSC, the shares opened up at 467 and finished the day at 524. I mean, I think the only thing I can attribute it to is that people think of this company as being a bit like an internet stock of old, that they've seen where it's come from, and they're anchoring on those lower prices, and they couldn't quite adjust to the fact that actually what we were seeing here is a build-up of a very significant business. And also, I suspect you had a lot of people coming in here at £5 who wanted to get their money back. And that's why we ran into that kind of muted response at around that point there. Right. So obviously, the question that came to my mind when I was investing was, well, how long can this company generate these level of profits? And I put together a set of fairly basic projections where I was really looking at what this business could do through to the end of 2021, and then looking at what I assume would be the net asset value at the end of 2021 and comparing it to the market cap today. And it was showing me that I was more or less buying the business for the market cap at the end of 2021 without coming up with any ridiculous assumptions. So there was an asymmetric risk and reward opportunity there. And now it's probably trading ahead of its projected NAV. But what I've come to understand is that this business has the potential to go on beyond 2021. And I've listed here a variety of reasons why that might be the case. Even a vaccine or a number of vaccines won't themselves be the silver bullet, sadly. We don't know how long antibody protection lasts. We don't know whether the these vaccines will reduce the infections or alleviate symptoms. We don't know how long it will take to roll out the vaccines and who will receive them. Of course, not everyone will have had a vaccine by the end of 2021. I've seen some reports saying as only about 50% of the people in the UK might have been vaccinated by the end of that period. And so there may be a demand for testing at some level through to 2027. So I think there is an opportunity for this business to consolidate and build upon these successes this year and next year, and go on to become, as it hopes to become, a mid-tier diagnostic company focusing on respiratory diagnostics and transplant diagnostics. And here, just some figures. Now, I've managed to get access to the Numis brokers report. This is their base case assumption, which is not unrealistic in any sense. And they're looking at revenues this year of 305 million, next year of 386, falling away to 136 million in 2022, and thereafter 97 million and 81 million in the years thereafter. And they're looking at EBITDA or profit before tax, whichever line you want to take, sort of maxing out at 280 million next year and dropping by 2024 to around 20 million of profit per annum. And they've got two other scenarios. A bearish case, which is the grey. The base case there, I should add, is the black one, and then a more bullish case, which is the blue. And you can see that if one looks at the cash scenarios, you can see that certainly with the blue bull case, that exceeds the current market capitalization, and we're not too far off with the base case either. And these are the key assumptions that they make. So under the base case, which I'm very comfortable with, we're looking at a first phase of that DHSC contract, but not the second phase. And under that scenario, they come up with a valuation of £9.50, but that's assuming no further contract wins. And I think that's the key point. So, you know, no big contracts to provide MPT to care homes, etc. The bull view is that they do win that second case, but otherwise everything else is more or less assumed to be the same. And with that one, they're thinking about 30 million of EBITDA 4 years out rather than the 20 million of EBITDA under the base case. And they come to £15 on that one. A bearish case, which assumes that the company just returns to break even again by 2023-24, £4.50. And then they have a blue sky one, which assumes maximum revenues from the NHS contract and further contract wins, etc. So at £34. So, you know, you pay your money, you take your chance. But from where we are at the moment, you know, I don't think that the base case is difficult to get comfortable with. I'm very happy with that one. And I can see potential, if new contracts are won, of doing a lot better than £9.50. So that, I'll stop my share at that point and let everyone join in.
Great, thanks, Leon. That's pretty comprehensive. I feel like we need a view of somebody to give us the worst case scenario, and usually that falls on you, Kevin. I'm always told, call Kevin Mr. Negative, but you're not.
That's not very nice, Dave. Look, I'm afraid I'm going to disappoint you. I'm really sorry, because yeah, it is genuinely the case that this is a company that could easily generate more than its current market cap in cash over the next 2 years. And as surprising as it might seem, just from looking at where the company's come from, you know, only 9 months ago, it's the right price, and it could easily go a lot higher. And I am long, for what it's worth, Dave. So it would be rather unusual. I've tried to share my screen. Has that worked?
Yeah, we can see the Stockopedia screen. Good.
The only point I would make is that there will be some negative news at some point, because and if you read the annual report, you'll find that there's a long-term incentive plan which is going to pay out in November 2020. and the Times has already picked up on this story. I don't have a subscription to the Times, so I can't give you the full story, but it says that it could be in line for Burnett is worth almost 5 million. That's probably on the low side. It's a phantom share option plan where the payout is linked to the share price in November 2020. And some of these guys are probably going to be taking £10 million. So that's going to bring some negative attention to the company, but hey,
No.
It doesn't stop me being long.
No.
From my understanding, this is one of the surprising things in the company was that the management didn't have that much equity already, and in fact, this is really not very broadly held by institutions. This stock, this is a share which is and I'm long as well. I bought in heavily at £5. You know, on the stock report, you'd see the stock rank flew up to 96 after results, and I went in heavily and started doing a lot of research as it was looking incredibly strong, and you know, I just saw the contract and thought that's just silly, and it needs to revalue. But this is predominantly traded in France. This share, I don't know if everyone is aware of that who's listening. It's about, I think 70-30 is the split. It's dual listed in the UK, and from what I understand, this is one of the most heavily traded shares in France at the moment, according to Keelan, who did the big write-up on Stockopedia, which but we're looking at the ownership structure, and I don't know if we've got all the data. We get our data from Refinitiv, but the ownership structure, it showed it only had about 8.5% owned by major shareholders. Yeah, it's still there, and I'm not sure. I mean, this database is very, very good, and it goes into all the Icon terminals in the city.
Yeah.
But it's a very small amount, and we've tried to dig around and see if there are any other, you know, sources, because I was so surprised not to see more large institutions in there. But from what I understand, it's actually very broadly owned by private investors in France, because obviously it was so small for so long. Which could, you know, it's interesting from the bull case, because you'd think that institutions may have to start buying this in size if this starts looking like a sustainable mid cap or large cap. So it's a very interesting situation.
Yeah, you're a fund manager, Melwyn. Will they have to buy it? Are there rules where some will have to buy because it enters into a certain size and new index?
Yeah, so they do, they actively did have, I don't know the latest update, probably Leon would know, but they did have a buyback program with some French agency who was buying back their stock. But the reason, and we will talk about Omega, but if you really looked at the financials of Novacyt, OpenOften, when Omega, of course, Novacyt, Gene Drive, in, let's say, November, December, I think Leon or Ed or David, you or me, would take 10 seconds to chuck the annual report in the bin. That's a fact. That's simply a fact. And it's amazing as to how COVID has just changed it. And when I've spoken to a few buy-side decision makers, they're saying, oh, no. So either the feeling is that they are too late, and therefore that 4 has become 6, has become 8, has become £9, so they're late, or there's still some doubt in the story. And there is no doubt in the story, because people are just anchored with the old information.
Yeah. I mean, this looks at an ideal one where the private investors have got in well before the institutions, and the institutions then have to buy later, and we're the ones that have benefited.
Well, David, I think this is one of those stocks where probably half the shareholders don't even know they have the shares.
Oh dear. Oh God.
And it's in the loft somewhere. Because if you really look, there is, Ed is absolutely right, there is no institution shareholding. It's amazing as to how many shares are traded even here. I mean, add that to the French exchange and God knows how much it is. And at the risk of even coming to Omega Diagnostics, I think if you see one trend across all COVID stocks, is basically it's become a very punting ground, really.
Mm.
And
yeah.
the old folks who are in gold and who are in gold mining and oil and gas exploration have all jumped onto COVID stock.
it's really kind of crazy on Twitter about the COVIDs. You know, these COVID stocks in a time when, you know, okay, maybe some precious metal stocks have done very well this year, but the old hunting ground of AIM has always been energy. You know, anything drilling for a hole in the ground, whether it's mining or and everyone, all these people burned in things like Sirius. You know, that there is always a whole huge cohort of punters who are looking for fast moving shares, and this is where all this hot money is going. And there are so many tiny scale investors in these shares, and so the churn in the shareholder base is just super fast at the moment. And also there's a huge amount of rumor out there about these stocks, and a lot of people aren't doing enough research on them to actually understand, you know, actually which types of testing each of these companies does. And I'm still trying to get to grips with it myself. I mean, I still am not. I've been trying to figure out Omega Diagnostics, and I don't know. I mean, I'm looking at Novocyte and Avacta primarily myself, but there's so much information out there, and you just have to try and navigate it. But the disinformation that's out there, and also a lot of market manipulation is going on as well. It does appear that there's a lot of disinformation out there on these shares. So you've just got to try and rely on the official news flow, and that's the one thing Novocyte's got, and it in my opinion trumps the other ones, because you've actually got the orders coming through. You've actually got this, you know, enormous jump in profits and sales, and it's actually coming through, and all the numbers are actually there, public, and that's why it's had this extraordinary move. But the hot money that is desperate to move the other ones, well, it's got to wait for the orders, in my opinion.
Like you, Ed, I've felt quite uncomfortable within Novocyte, holding Novocyte, because of the ramping that I see on Twitter, and a lot of it's unfounded, and only looks at the positives. And you've always got to be wary when you see that. But I have to say that, you know, the Numis report trumped my own forecasts, and actually was probably pretty close to what some of the sort of wilder people out there, the commentators, are saying. So, but I would stress that you know, I generally like to invest in companies where nobody else is making loud noises and big claims.
Although Numis's note did say at the top, this is marketing communication.
That is true, but they do have a reputation to keep.
Okay, well, I guess we've covered that one, so we need to come to our decisions. Should we start with you then, Ed?
Well, I'm a buy. I'm long, and I'm a buy.
Okay. Melwin?
Buy on dips.
Yeah, good maneuver, yeah. And Leon, I guess
I'm a buy.
Yeah. Kevin?
And I'm a buy as well, Dave.
Oh my gosh.
I'm sorry to disappoint you.
It's a full house. I mean, I was like Leon. Although I was late buying, but I did buy on the results announcement, and I'm a buyer too, especially on dips. I think that's really good point, Melwin. Great. Well, we've now got a poll, so this is for the audience to let us know how they feel about Novakit. Great. Well, that's looking like everyone's voted. There we go. There is the result. I'll share it with you all. Hope you can see that. Buy is certainly well out in front. 57% of you. And 6% even wanted to back up the truck. So I think that's fairly conclusive. We make all these polls, and we will review everything in a session later on in this series. Great. Okay, I'll close that one. The next company we're going to look at is going to a different sphere, although we will come back to Amiga later. Connect Group, which is one that Kevin and I have probably known for quite a long time. Seems to have recently caught favour. Kevin, do you want to tell a little bit about Connect?
Yes, certainly. So I'm standing in here for Professor Glenn Arnold, who's very keen on this, but unfortunately couldn't be here this evening. Connect was originally part of WH Smith. It was the newspaper and magazine supplier to the WH Smith Group. However, it was 14 years ago now. It was demerged back in September 2006. And back then it was called Smith's News. And the demerger argument was that if Connect Group was separate from WH Smith's, then other newspaper sellers and news suppliers would be more inclined to use its services. And that worked out. Smith's News acquired a competitor. They won national distribution contracts from other newspapers. They expanded into book distribution, and everything was going great until in 2014, they expanded into parcel delivery. And at that point in time, they built up their own internal brand, and they also acquired Tufnell's Parcels for 113 million. And this is the point in time when they changed their name to Connect Group. The idea was simple enough. They thought, we've got a network of vans driving around the country delivering newspapers. And if they add another similar network of vans driving around the country delivering parcels, there should be some synergies from combining the groups. But let's just have a quick look at the share price to see what actually happened in practice. So you can see back here, this is November 2014, when they first made the acquisition of Tufnell's. It was 113 million, partly funded by a rights issue. And they traded sideways for a number of years, and there wasn't any real integration. And then here, towards the back end, in August 2017, they announced that there had been a challenging year with some significant strategic progress. And at this point in time, they were optimistic that there were going to be some material cost savings from a step change in integration. So this was around about October when they announced the 31 August 2017 results. But it was only a few months later in Jan 2018 when they announced a poor trading update and that the integration savings were going to take a lot longer. 6 months later, in January 2018, they decided to close their own internally created brand, which was Pass My Parcel, which was delivering parcels together with Amazon. And they announced that there had been a material decline in volumes at Tufnell's. And at this point in time, that the CEO fell on his sword and left the business. So the share price dropped really dramatically. And it's been a pretty miserable story for the last 18 months or so. But back in March, April time, they finally announced that they were going to draw a line under all of this. And they announced the disposal of Tufnell's. And they're selling it for £15 million. But to add insult to injury, that 15 million can be deferred for up to 2 years. And what's more, they had to make a loan of up to 10.5 million to the purchasers for working capital. So, I mean, it's been a disastrous period of time from here downwards. However, moving on, we're looking at the trading update on the 1st of October. Now, without the distraction of Tufnell's, they're now saying that the forecast adjusted EBITDA for the year is going to be around about 38.5 to 39 million. And net debt was not a problem with net debt. It's going to be around about 2 times EBITDA, which is comfortably within the right sort of parameters for a listed corporate. And the loan wasn't actually fully drawn. It was only drawn to £6.5 million, been fully repaid. So they're sitting back waiting for the deferred payments to be made for Tufnell's. So at this point in time, you've got a business here, Connect. It's got the market cap is 62 million pounds. It's forecast to trade on an EBITDA of about 40 million. I would expect a business like this to trade on an EV to EBITDA multiple of between 6 to 8 times, which implies that that equity market cap should be somewhere between 160 to 240 million, which is obviously materially more than the 62 it is at the moment. Putting that into a PE context, if you can see at the moment it's a P of 2.7 times, and if you have a look here for the sector trades on a PE, a median P of 14.6. It's probably not going to get to the median PE, but this is trading way below where it should be. This is a classic turnaround value play, and caveats aside, assuming that the management don't make a dumb acquisition, and that CEO has gone, I just think that this is a great buy. This is back the truck up, load up big time. This is the turnaround that Ed was asking for earlier on when he was talking about his own investment club.
I know. My eyes were. I hadn't looked at it before, actually. You know, I'd looked at it before this meeting, and I was very interested. You know, there's a lot of stocks like this in the market at the moment, which are seeing, you know, all kinds of sort of change in the management level and change in the business. And, you know, you think when we come through this nasty period, there are going to be, you know, where you've had this K-shaped recovery in the stock market where, you know, yes, the tech and healthcare stocks have all done very well and everything else has been trading pretty poorly. You know, when the market changes, it's going to re-rate a lot of shares dramatically. And this looked to me, and I really don't know this at all in very well whatsoever, but I did look at the sort of the debt situation, and obviously you have all this IFRS 16 lease adjustments that they have to report on now, which, you know, depends on what your thoughts are about that. But you know, obviously they're having to report much more debt than they might have in previous eras. But it looks like a very much more simplified business. I'm a pretty simple guy. I obviously you've got what I would say is a very bad trading environment for news and news publishers. And they're all, in what I can see, so grabbing headlines that they're almost decimating their newsstand businesses because all their headlines are keeping everybody at home and propagating the fear. But I did note in their latest release, didn't they say that they finally got their mail group, the Daily Mail contract and the Mail on Sunday, and they are booked solid to 2024. Which surprised me, and because, you know, if you look at the turnover, you look at the sales trend of Connect, it's gradually declining every single year. So they're selling less and less and less every single year. So there's no doubt the industry that's is in a kind of long-term decline, but you know, they seem to be managing that. It's a very predictable decline, so the sales trend is quite downwards like that consistently, but they are managing it pretty well. And as you say, it's on what looks like a very, very, very cheap valuation, but it's just super out of favor. And of course, I like the stock rank. So, you know, it just gradually increased up to 91. If you hover over the turnover trend, the revenue trend in the summary down below, that should show that picture of this sort of steady decline. It actually seems to have leveled off recently. But yeah, I found this very interesting, and actually also on the ownership, I like using the ownership data quite a lot. But I've noticed quite a few deep value investors have been buying this quite heavily. There's a family office that's bought quite a slug recently, and it's been being sort of quite acquisitive. A lot of those major holders, you see the Fidelity Special Situations funds, and there's actually was another one that isn't on here that I managed to snuff out recently. I can't remember what it was called, but again, a kind of a deep value specialist. Now, of course, a lot of deep value specialists have been going out of business recently, as we've seen. Yeah, this one I found quite interesting.
Kevin, how would you compare? Sorry, go on.
No, go on, Melvin. You're a typical fund, small cap.
Kevin, how would you compare this to DX Group and Wincanton?
DX Group, I know. What was the other one?
Win, WINCAT. WIN.
Wincanton.
Yeah, the first. That's right. That's right. The first one. No, yeah, WIN. Yeah.
Look, I mean, I haven't compared them. There is a wonderful tool on this where we could compare them, but I mean, Wincanton is more of a specialist distributor, isn't it? In terms of
that's right. They need it for groceries.
Yeah,
the business is not in decline.
So I mean, you can see. I mean, it's a lot more expensive. It's got a marginally lower stock rank. It's still got decent positive momentum. Wasn't quite there in the same sort of quality as we
and
had.
DX Group.
And DX Group. I mean, DX Group again is a turnaround situation, and the management there have done a great job.
Delta X-ray.
And I would say DX Group are much further into their turnaround than Smiths and Connect Group. But then at the same time, I doubt that there's much there for Connect to actually do in terms of turning around the group. It's just simply bringing management focus onto that, what was the Smiths News business, and getting rid of that legacy that is Tufnell's.
Do you think their goal now is just to pay the debt down? Because for every pound of debt they pay down, equity value rises by £1, or market cap. Equity value.
But it's 2 times EBITDA. I mean, that's not a level that would personally concern me. So I mean, perhaps if they take it down to 1 times EBITDA, but it's generating great cash flow. The cash conversion of EBITDA to cash is around about 81.5%.
I suppose the decision would be whether they do anything with that cash to improve their overall future outlook, or whether they give it back to shareholders, as it were. Yeah.
You hope that they're going to give it back to shareholders, just in the same way that we hope Noversight are going to use that prodigious amount of cash that they've generated and give that back to shareholders as well.
Yeah. Well, I have to say, when someone like you, Kevin, says load up the truck, I start to get interested.
It's classic value. I mean,
yeah. Great. Well, shall we make our decisions on Connect? Melwyn?
Well, a person who, the Melvin of 10 years ago would have said, absolutely load up the truck. But David, just to connect this to my 2 mistakes I've made in, sorry?
You haven't got a truck now then, 10 years later.
Exactly. So I would say in my 2 principal mistakes have been in my 20-year career is buying cheap stocks and selling stocks thinking they're expensive. They have costed me multiple figures. And I would say this certainly is worth doing some work on, but I'm not going to be instantaneously enticed because of the P multiple.
Okay. So hold?
I would say hold, between hold and buy based on the author of the article.
Okay. And Ed?
Well, after my afternoon's research, I feel like I need to do some more. I am somewhere between, I'm, as I said earlier, I am itching to try and find more good turnaround candidates, and especially ones that have struggled with debt. I read some really good work by a chap called Dan Rasmussen, who did a podcast on Patrick O'Shaughnessy's podcast that was really great, introduced me to him. And he talked about how private equity returns can be generated just by buying publicly listed levered small cap value. And I found it a really interesting way of looking at, because most people just screen out anything with higher gearing. And so from that perspective, I've been, I have a bit of I've always had a bit of a growth bias and tending to try and buy premium shares, but this has rather changed the way I'm looking at it. So from that perspective, and given Kevin's given it a good pitch here, I'm going to say buy.
Okay, that sounds a good podcast. What was it again, Ed?
There's a wonderful podcast called Invest Like the Best. I listen to almost every episode. It's James O'Shaughnessy's son, called Patrick O'Shaughnessy. He runs O'Shaughnessy Asset Management, and it is that one. You can find it on it's a combination of startup stuff and investing stuff. But he's now CEO of O'Shaughnessy Asset Management. If you ever read What Works on Wall Street, he's the son of the author. It's a terrific podcast. Lots of brilliant people on there. But the one I was referring to was Dan Rasmussen, Rasmussen. So if you search for Invest Like the Best, Dan Rasmussen, that's a brilliant one. I really enjoyed it.
Excellent, excellent. That's the good thing about the bash. You never know what's going to get thrown up and what's going to be a little nugget of information.
Yeah, for value investors, that is a really, really good one to listen to.
Brilliant. And Leon, what do you think?
Well, again, it's not really my style of investing, although I do like opportunities that have this asymmetric risk and reward profile. I think I could be persuaded to buy it. I really want to know, where could things go wrong here? I think they've got a pension deficit. Maybe that could become a problem. But the problem is when your top line isn't growing, and indeed in this case it's falling, you're always under pressure. So I think I'm somewhere between a buy and a hold, but I can't get much more excited than that at the moment.
Okay. Maybe we need to get the management of some of these companies in the following month to talk to us. Anyway, Kevin, I think we know where you are then.
Back the truck up.
Back the truck up. Great. Well, I must admit, I think, having heard you, Kevin, I'll be probably buying some in the morning, but I don't make that recommendation to anyone else. But certainly I'm a buy, I think, on the metrics we've had. Great. And let's see what the audience thinks. We'll send the poll out now. Okay, I'm going to share the results. Interesting. Yeah, we fairly across the board there. We got buy 34%, avoid still 25%, hold 31%, and just a few with you there, Kevin, loading up the truck, 4%. So there might not be quite as big a rush in the morning, but still looks interesting. And we'll pick up on these results and the comments we've made in as I say, in a future show. Great. We'll end that one. And our next company, I think we're back again to one of the COVID stocks, Amiga Diagnostics, which is your area, I think, Melwyn.
Sure. So I'll share my screen now.
Oh, let me stop sharing. Okay.
Yeah, can you see that, David?
Yeah, we can see that.
Cool. So good evening, everybody, the audience, and obviously the panelists we've been talking about. I manage a small cap fund called MI Sterling Select Fund. First of all, I'm going to talk to you about Omega Diagnostics. I hold the shares, so obviously my views are biased. They're not independent. So please do not take this as a recommendation. So Omega, actually, given the size of the company, this is actually quite a complicated company if you really think of it. And they're not, you wouldn't give them a prize for writing good RNSs. They're complicated. The English is obscure. Paragraphs are mixed up. But I think that they're slowly getting better over a period of time. But this is a classic company where the management is really not, what should I say, stock promoter savvy. But they're obviously now getting more and more pressure to kind of communicate properly. But when I say again, when I say Omega, 8 out of 10 people say, "Oh, Omega, that COVID company." But actually, COVID is a very recent story. So on the left, you can see there's a bread and butter. David, I'm audible, right?
Yep.
Cool, thanks. So the bread and the butter business, food tolerance and infectious disease, and really the jam tomorrow is a COVID. And actually, I do think in this case, they are behind Novacyt as far as COVID is concerned. But actually, that's not the reason I'm buying this stock. I'm buying the stock for the bread and butter business. So I'll really start with the food tolerance here. So the food tolerance business, I'm just kind of going to read through my notes, which I've written here. The food tolerance business is really So first of all, I think I must say this to you, that we should not confuse food intolerance with food allergy. We all know when we, some of us may, some of us may not be, but if we are allergic to food, you get a swelling, you get spots, pimples, whatever. This has nothing to do with that. This is food. Basically, reaction is not immediate, but can have a long-term physiological impact on your own health. And of course, as people are getting more cautious of what they eat, how they eat, I think or each of our bodies can take and cannot take a particular food types. So kind of it helps in that. And I mean, I was kind of looking up. This company was formed in 1987. It's going on for 33 damn long years. And as I said to you 5 minutes, 10 minutes ago, that had you shown this company, financials last year, it would have gone straight in the bin, really. But obviously things have changed a bit here. So they've got two kind of parts of the food intolerance business. One is what they call as the food detective. That's the name they use, by the way. So it's a point of care test, and which can test the your body's reaction to 59 different kinds of foods, and you can have a test within 45 minutes. Again, it's basically, as I said, to the patient. There's another test called the ELISA test, which is the food print test, which again talks about it really measures the antibodies, food-specific antibodies, and over 200 kind of different foods in your body. And not today, but when I first looked at the stock, I was kind of got smacked to believe that a company, a British company, 33 years old, doing revenues of 8-9 million in this business, exports to 70 countries. I mean, talk about a British gem hidden somewhere, God knows where kind of thing. And there's a classic example of one of the many examples of so many lovely British IP companies not able to scale because of cash constraints. So I would say the business is slowly kind of getting momentum. And funny enough, out of all places, the new demand really is coming from China. They have a local partner in China who has spent actually $2 million for the distribution of this test in China. And it's very interesting when the Chinese start spending money. I like that combination. So they're going to go ahead and last year, for example, in the full year, they've sold around 98,000 roughly tests. And in June alone, they sold 28,000 tests. So I think they're just coming up to that, dare I call it, the hockey stick impact coming in here. And so the first part of clinical testing has been approved by the Chinese FDA. Now there's a test currently being, they're in the process of being approved for personal use at home. And if that comes through, roughly 1 million tests could be sold on an annualized basis over the next, but let's say by 23, 24. And if this company makes a revenue of, let's say, £1.50, I've really been I've taken lower figures than expected, because the Chinese market is a very price competitive market. That's revenues of roughly 12 million. And this is a business with easy 60% margins, easy. That's 5 million profits perpetually. This is not a kind of, year for 2 years, year for 4 years. This is that 5 could go to 7, could go to 9. As you know, the population of China, there's a long, long runway. So that's, I think I'll shut up for food intolerance because it's quite detailed actually. Infectious disease. Now, of course, we really don't know much about infectious disease in this country, but as we know, Africa especially with HIV and AIDS. It's a very, very serious problem. And this, they basically have two kind of tests, the VISI 350, which is an older test. They've got a VISI Advanced, which is obviously the advanced test. But the key thing is that it's a few parts of the puzzle are just kind of coming together. And what do I mean by that? Firstly, the Nigerian Health Authority has approved this test to be sold. So it will be going on government mandated infrastructure and distribution. The WHO has kind of passed this test, which is extremely important because once the test is approved by WHO, it can go on to, it is kind of pre-qualified and it goes to PEPFAR and other UN agencies when they buy these tests. So the bottom line is that the global market for this test, I would say 90% of the market is around 10 million tests in the next few years. And in 3, 4 years, 5 years from now, this company could be selling, again, very roughly 5 million tests, which could generate 5 to 7 millions of profits, bottom line profits, till perpetuity. So I think that's enough on infectious disease. The third part, where I'm coming to the jam really here. Now I'm going to be focusing on the right-hand side box, which is the UK consortium led by Abington, BBI, and of course, Omega is part of that consortium. This is obviously a home test. The government has started the first order. It could be multiple million orders. It's also obviously received the CE mark. And Omega is 25%. It's got a 25% share of contracts. So if it's a 10 million, it's 25%. It's 1 million, it's 25%. And I think that can be a nice, even at low margins, this can be a nice cash cow. And the Mologic partnership, where I've taken the left-hand side, where obviously there are two antigen tests, two ELISA, two lateral flow tests. In my view, and I'm not a champion, I think I know, but every day I'm learning new things about COVID testing. I think I was very excited about antigen testing 6 months ago. I'm no more as much excited about it. There is something in antibody tests there. And I think if you add the sum of parts, there's a lot of core business in there, which could be really between 5, 7, 10 million of profits annualized for God knows till when, versus this business, which I really think, God willingly, I hope COVID business is not alive for too long, though I am an investor. But till then, it's got a play, dare I call it, to the COVID problem. I think I'll stop there, David.
Okay, thanks, Melwyn. That's covered a fair bit of Omega. Any views on this one, Ed?
I think this is one of the COVID's. Obviously, Melwyn's been looking at this from multiple perspectives, which is great to see, because a lot of these, businesses did have prior operations, and I really don't know Omega Diagnostics at all, so I'm really not sure. And I know there was news out this morning, and it didn't respond as favourably as one might like. Meanwhile, Avacta, that I believe they are in sort of cahoots with in the the rapid testing consortium, that one's sort of spiking away, and it's got perhaps a lot more blue sky potential. I'm going to bow out because I really don't know much about Omega, and I don't think it's appropriate for me to really comment on it. So I'll leave that to others.
Leon?
Listening to Melwyn, it's like sort of someone's talking about an ex-girlfriend of yours, and extolling her wonderful virtues, and you're scratching your head thinking, why did I never see it when I was going out with her? you know, I have held Amiga both previous to the COVID crisis and since, and actually I've always done okay with it. But this is a company that has always overpromised and underdelivered. It made huge claims about the likelihood of its success with its HIV testing, which is now many, many years delayed. What I will say is, though, that HIV experience that used a lateral flow test did give them a huge amount of expertise. And when you think about Avacta and its claim or its hopes for its own lateral flow test, what's clear given the delays that have since happened with Avacta is that they didn't really understand what was involved in the process. Whereas at least Amiga Diagnostics do have some credibility in this area, and they can also manufacture lateral flow tests, and they have had to deal with some of the problems. I remember they wanted to introduce it into India, and they found that it didn't actually work. They trialed it in India, and they found that their original test couldn't work in humid conditions. So they've had to rework things. So, and I realize that they've made some disposals as well. I did laugh when Melvin said, they've been held back as a small company. They've not been able to scale. But the reason why they could never scale is that they were always losing money. I think the figures here show it. They were quite good at producing a profit, but the profit always came as a result of capitalizing lots of costs. But moving forward, there's some interesting stuff they're doing. I take a different view from Melvin on the antigen antibody debate. I think that it's antigen where you need to be. We don't have, and we have no likelihood of having some kind of immunity passport that would make antibody testing really thrive. They might use it for surveys and for understanding how effective the vaccine has been and how much herd immunity there is, but I can't see it being used widely on an individual basis. So I'm skeptical here. I would be nothing more than a hold. In fact, I'd probably lean towards selling at these levels.
Kevin?
I agree with Leon, and he's pretty much said exactly what I would say. They disappointed so much in the past, and I can't see any great evidence that they're going to get any great traction at this particular point in time. The company that I compare them to is Allergy Therapeutics. And if you sort of, see on the stock rank 87, look at the revenues that are coming from Allergy Therapeutics, which is just so much better than what's coming out of Omega. And I almost bought Allergy Therapeutics, really, almost. Didn't quite get there entirely. So on the basis that I think Allergy Therapeutics is much better than Omega Diagnostics, and I didn't quite get there on buying Allergy, I couldn't say buy for Omega. It's disappointed so much in the past.
Yeah.
If it shows evidence of getting some traction in the COVID testing space, I'll change my mind. But yeah, not there yet.
I've never really had a look at Amiga, and not one that I know from the past, although I do know one or two have been in it over the years, and they seem disappointed. Looking at the stock ranks, they don't look too good really for Amiga. The momentum's great, but that's why it says it's a momentum trap, I guess.
Well, I think that's going to be what's interesting about a lot of these stocks that have been inflated due to COVID is, the momentum traps, which have the pure momentum, some of them turn into what we call high flyers. They start seeing the sales and the profits, and that's what's happened to Ensight. And it's separating the ones which succeed from the actual trap stocks, which is, I think, the $1 million question really. Who really knows? And I don't think anybody really knows. Has anyone got the real intel? I mean, I know there are some, there are some extremely bullish stories I've heard on Avacta. As you said, Leon, they've sort of the can keeps being slightly kicked down the road. But there seems to be a lot of blue sky thinking in that. My brother has been absolutely harassing me to go deep into Avacta, and I've been holding back. You know, I think it's going to be interesting to see that a lot of these stocks are going to be seen as momentum traps when this all sort of falls away. I mean, the whole biotech sector has rallied so strongly this year, and not all of them are going to come true. So yeah, Omega, I actually, what I tell you what I've struggled with, and I think this is what's interesting in the market. I always go back to that sort of Peter Lynch idea that you need to be able to explain a company in a few, you know, to get it very quickly for that message to propagate around investors. And I find Omega quite difficult. I sort of struggle a little bit to get to grips with its model. And, you know, and there's obviously a lot in there, but, you know, you see something like, you see these stocks divesting businesses and arms. I don't know whether we'll, you know, we'll cover Avon but Connect maybe is another one, but, you know, they simplify and maybe it's easier to understand as a proposition.
Yeah.
Yes. No, Omega for its size is certainly much more complicated than it needs to be, undoubtedly.
Okay, well, I'm going to launch the poll and see what the audience think after all that. Ooh. Okay, there we go. Sharing the results with you all. Ooh, 50%, half the audience think avoid. Sell also 27%, so that's fairly conclusive. The two people though want to back up the truck, so if they get it right, we'll bring them back on the show, I think, in a few months' time. If they get it wrong, I don't think they'll want to go anywhere near the show, but anyway. Okay, that's the end of that one. Now, we are running a bit late, but I don't know if maybe we can cover one more. You guys all right to cover Avon?
Absolutely.
Leon, if you want to lead off then.
I know nothing about Avon except for the bit of research that I did today, so I'd prefer not to lead off.
Anyone else want to lead on Avon? Looks like you get the job with the research you've done today, Leon.
Oh, blow.
Well,
I suppose when I realised it wasn't a plantation stock, I did breathe a sigh of relief, and you know, I couldn't help but be impressed by its. I don't know if you can go a bit higher, and you know, impressed by its core business, which is providing helmets and other products to the military. And then it's got another product where again rubber is being used, and various tests are done linked to milk processing. The milk processing business is less profitable than the protection and respiratory protection business.
It's been sold, actually, I think, or it's in the process of being sold, the milk business.
Oh, is it?
Yeah, I think.
Yeah, the milk business has been sold for 180 million.
For how much?
Yeah, 180 million.
You guys need to take over from me. You know much more about it than I do.
I've only got an afternoon's research into it. I'll tell you what I know, and I know that you know, I know there's quite a lot of people have done well out of this share. It's sort of been in a bit of a transition from one, you know, business model to the other, and maybe a little bit of a confused business model. Yes, it's had the milk business. You know, and I don't really know too much about it, but I think from the rubber side of things, but it's been sort of supplying to that industry for a long time. But it's now, and you know, obviously been focusing on personal protection gear for military and law enforcement, and that's a real growth area, especially in the kind of Trump era, you know, where you've got a lot of, you know, I mean, they've got a lot of contracts with the US military, and actually I believe they're going to be changing their reporting into dollars quite soon. So actually, when they announced that they were sort of selling out of the Milkrite, the business, they also very quickly announced what's the business called?
Team Wendy.
Yes, exactly, Team Wendy, which is another business that does a lot of actually sells into about 50 countries. more helmet systems and so on. And that's, I think, $130 million or so. So a lot of that cash they put to work. And it's like they're really trying to focus on this, actually a very kind of good margin niche, which is very, very attractive to investors because it looks like it's actually really quite defendable. They've got like they're getting a bit of a kind of a moat in that niche market, good pricing power, good margins, multi-year contracts. And they've acquired, I think, was it Ceradyne as another from that's the ballistic helmets business. So, but it's very punchy. It's very expensive now. And I mean, this is one that I didn't buy, and it was on an 80, 90 plus stock rank a few years ago. And you know, so it's had a really good run. And this is actually, no, it wasn't this one, but obviously there's been a lot of multiple expansion, a lot of, you know, it's now on a 1.3 billion market cap. Been a lot of like, I guess, institutional money coming into that, and they love a story like this, and they can really push up the multiple. So, you know, you've got the sales growth, earnings growth, and then the multiple expansion has led to this kind of rocketing share price. So, you know, very, very interesting. I just, for me, it's too pricey now. I got onto this story far too late. I sort of heard it on some podcasts this year, but I hadn't, you know, I sort of ignored it because I thought it was for so long previously, because it was like, you know, I just, anything with milk attached, and I just think, no, can't go there. But, you know, even in these businesses with milk, you can have these, it's an extraordinary mashup of businesses, but it seems to be, you know, it's in a good spot. And a lot of people are very, very bullish on this stock. And, but I personally think there are other opportunities I'm interested in, but, you know, a lot of people are very, very bullish, and there is potentially a lot of growth here, you know, if they can keep, you know, focusing on this niche and cross-sell into different markets, different customer sets, could be interesting.
Over to you, Kevin.
I was reminding myself over the weekend that I looked at this around in 2004 and decided not to buy it. And obviously, what's the point in listening to me? Look, it's a great business. It's done really, really well over the years, and it's well focused. My issue is just the rating at the moment. I just can't bring myself to pay 34 times forward PE for this. It just feels as though that the rating expansion has gone too far. I'm not calling it a short. I wouldn't say it's a sell at these levels. I would struggle personally to say buy. It's definitely a hold.
It was only the other week when I looked at it that I realized how big it had got.
Yeah, I mean, 1.3 billion, it's enormous.
Yeah, no longer a small cap, that's for sure.
And I think it's done that without having to issue any shares as well. I mean, you can see there the...
Yes.
Yeah.
I mean, management have done phenomenally well. They sold that Milkrite business on an EBITDA multiple of 18 times. And I don't know how clean the operating profit number was, but they only did 4 million of operating profit, you know, against a consideration of 180 million. So
fantastic price achieved, Leon.
So yeah, you wouldn't want to bet against this management team.
No.
And funnily enough, I'll just bring back in some of the comments that have been made, not on Avon necessarily, but on the Connect situation. Somebody who's met the management, and I'm wondering about the new CEO. They say, have you met the new CEO? He ran the news division for a long time. A very impressive guy, always finding savings. So in many ways, some of these, you've got to look at the management quality and see what they're up to. And at Avon, they've clearly done well in timing sales correctly. And also, somebody's mentioned, rather than just Connect, why not look at Reach, a similar business and a similar PE, but with no debt? Wow. I think Reach is the old Trinity.
But the problem with Reach is they've got pension problems.
Pension. So they're not focusing on that bit, they're only the debt.
Oh, they also have potential liabilities from the phone tapping cases.
Oh yes, yeah.
That hasn't been finished yet.
Yeah.
Well, yeah, I mean,
that would scare me. Yeah.
Someone has mentioned that I think he's talking about Avon's got declining return on capital employed. Could we just pop back to that screen?
Oh, yeah, I noticed that, but
I hadn't unpicked that, and I wasn't sure whether that was something which was, you know, focused in the milk right business or something else. I think you'd have to sort of break it down to try and get a clear picture going forwards. But yeah, that is a red flag to me.
Yeah, so return on assets and return on capital employed these have all been declining, and so the operating margin. And I couldn't quite get to the bottom of that, because when you look at the headline numbers for each individual division, you don't see that. And I'm afraid I didn't have enough time to get to the bottom of it and work out what was going on.
But anybody watching this needs to have a look at that to on a PDF.
And I haven't I did notice there are some really punchy profit forecasts of quite a sort of dramatic profit improvement. I haven't investigated that and where that's coming from. So this is one that definitely needs more research.
Probably... That's because the profits of the targets have been added.
Well, that's the thing. If they're on a very high rating and they can make good acquisitions, you know, you've got that whole bootstrap effect that can kick in, and maybe they're able to go and buy these sort of more subscale sort of protective, you know, defense units and really create a bit of a sort of niche category killer. That would be obviously is a very interesting proposition.
Yeah, they can pay out with shares as well if they want to.
Well, we aren't on the London markets very often able to say that this company is a leader globally in this space. Avon is a leader in this space.
Yeah.
Okay. You wonder if they should rebrand. You know, will they rebrand? Because, you know, it does Avon rubber. Is that really?
It doesn't really describe the business now.
Exactly.
Yeah.
Especially of the Avon milk. Great. Okay, so all our decisions made. Where would you be, Melwyn?
I would say I would load the truck up, but I would say because the valuations are that, I would say this is a long-term compounder with a very high quality, defensible, high quality management. It's a buy.
Ed?
I would hold if I owned it, but I'm not buyer here.
Leon?
Yeah, same as Ed.
Kevin?
Yeah, I'm the same as Ed and Leon. It's a really good quality business, but I just can't pay this price, so it's a hold.
Yeah, and I'm exactly the same. I'd be a happy holder, but that would be all I would be doing. I'd be very happy that we've got to this level, and that chart looks great. But...
I mean, I would buy it on this multiple if its returns on capital were rising. And they may well be for reasons that Ed has explained. So I think this is definitely one to watch, just to see how the metrics fall out when it reports with these acquisitions on board.
Okay, right. Well, I've launched the poll, so we'll see what the audience feel. Oh, looks like they're coming out with us. There we go. Poll's very much the order of the day there. 63%.
Quite a few sells there.
Yeah, yeah.
Someone's backing up the truck. They must have some inside intel.
It's always interesting. Great. Well, thanks, guys. That's brilliant. Always good fun, always entertaining, and certainly educating for those who like to see how those who do this every day see stocks and what they think and what they pick out as key metrics. And I'm sure everyone has enjoyed that session. What we do is to pay you effectively for your services. Paul picked his Zane charity for a donation last month. He's not here tonight, unfortunately, otherwise he'd tell us about it, I'm sure. But Kevin, I'd like you to pick a charity that we will, you don't have to do it right now, but Mello will donate £150 to a charity of your choice. Try and pick one where it will make a difference. I'm not necessarily saying £150 will make a huge difference, but
Isn't it going to be the former shareholders of Amiga Diagnostics?
oh,
Okay, let me think about that one, Dave.
I'm getting worried about Melwyn's ex-girlfriend.
Ex-wife.
Great. Anyway, thank you all four of you. It's been really good.
Thank you.
Everyone who's still on the webinar, and that's well over 200. It's great that you've stayed with us. The next one, and these are going to be really regular now. The next one's in 3 weeks' time on the 9th of November. We'll not have a completely new panel, but we will maneuver it around. I don't want to abuse any panel members by having too much of their time. And it does take quite a bit of research to look at these companies. But the next one will be on the 9th of November, and we have 2 in November. There'll be one on the 30th of November as well. So put those in your diary. Thank you everyone for staying with us. We hope you've really enjoyed it. We enjoy doing them, and it's good that you seem to have made this the most popular session, but hopefully you'll give us some feedback. When I close off, you should get a feedback form to tell us things that you feel we should know. One thing I'd like to ask you all especially is if there's anything that you would like us to cover in a future session, maybe you can let us know. We are happy to keep making things interesting for you, and do fill in the feedback form. Anyway, it's goodbye from me, goodbye from the panel, and see you next time on Mellow Monday.
Great.
Thanks, David.
Thanks, David.
Night.
Good to
Thank
see you all.
you.